Okay. Good morning, everyone. Welcome back after almost a week. Yes, so hope you guys are keeping well. So today's session, we again have financial instruments. So I have two classes with you. That is the class today and the class that is there on next Sunday. Okay, so today we will be doing some of the problems. We've done quite a number of illustrations, problems, etc. But there were a couple of problems which I thought, which I had mentioned would be done later. So those I'll be doing it today. And we'll be introducing you to a couple of new concepts. One would probably be a major one. And apart from that, the remaining concepts would be very small to understand. Okay, I mean, not very important and quite simple. Okay, so that is what is my plan today. Towards the end of the sessions, that is tomorrow, the next Sunday session, we'll be picking up whatever is left over. Okay, I'll see if I can touch up on derecognition of assets a little bit today. Okay, so financial assets and derecognition of financial liabilities as well. So if that is done, then next Sunday will be a couple of certain medium range concepts like hedge accounting, expected credit loss model. So these are the topics we intend to take next week. Okay, so coming back, I hope you could revise what has been taught to you, what has been discussed so far. Yes. So in the very first session that we had, I'll just briefly recap because it's been quite a long time since we have discussed the concepts. So in brief, we had discussed, started up with the definition of a financial instrument. And then we moved on to see what is a financial asset, which is essentially a right to receive cash or a contractual right to receive cash. It is cash or a contractual right to receive cash or another financial asset. So the important word here is a contractual right. So that is why all your statutory rights like income tax, refundable, etc. are excluded from the purview of financial assets. Okay. So we saw a couple of examples also of what could be financial assets and financial liabilities. So liability is exact opposite of assets. It is a contractual obligation to deliver cash or another financial asset. So this was the first part of the definition that we saw. Equity is a contract that evidences residual interest in the assets of the entity after deducting its liabilities. So there is no requirement of voting rights. There is no requirement of equity shares in particular. It could be any instrument that evidences a residual interest. So like your SBP reserve, all these which are given like equity component of a convertible debenture. So all these are equity because they evidence a residual interest in the assets of the entity after deducting its liabilities. Okay, so this is what we had discussed. Then we saw derivatives. In brief, what was derivatives? So derivatives, for an instrument to get classified as a derivative, it should have three important things. The first one is deriving value from an underlying asset. Settlement would be happening at a future date at an agreed price, and initial amount to be paid is going to be nil or insignificant. We had discussed this in detail in the previous sessions. When we saw the initial examples, we gave an example of forward contract, futures contract, and options contract, and all of them meet the definition of a derivative. Are all derivatives going to be financial instruments? Answer is no. It's like saying financial instruments include derivatives, but all derivatives are not necessarily financial instruments. So the exception is that commodity derivatives, which are gross settled, that is the own use exemption. So these are exempted from financial instruments chapter. Why? Because it is a contract to receive a non-financial asset. A commodity is a non-financial asset like gold, wheat, rice, whatever it is. Okay. So therefore, since you are getting a non-financial asset, it would not be a financial instrument. Okay, so this is the only exclusion from derivatives which are not financial instruments. Okay, then we saw debentures, preference shares. We came to the conclusion that we do not follow the legal form, but we look at the substance of the transaction. So if I have a preference share where distribution is mandatory, then the distribution, the cash flow stream involving distribution ends up being a financial liability. If the distribution is discretionary, it is equity. Likewise, if my preference shares or debentures are redeemable, the principal becomes a financial liability. If it is irredeemable, okay, then it continues to be a equity item. Okay, so this is what we had also discussed. Then moving to the other part of the definition, we saw that just a second, let me open up. Okay. Okay, moving to the other part of financial asset, we saw part A, part B, part C also we have seen. Then part D, a contract that could be settled, will or may be settled in the entity's own equity instruments, a non-derivative for which it is going to get a variable number of entities' own equity instruments. We saw the example of a sale made to a customer, and the customer is holding my own equity instruments and I am buying it back. So if it is a variable number that I am buying back, a contract that will or may be settled in entity's own equity instruments, a non-derivative for which the entity is obliged to receive a variable number. So if it is variable, then it becomes a financial asset. If it passes the fixed for fixed test, it becomes equity. Okay, a derivative that will or may be settled other than by exchange of fixed amount of cash or other financial asset for a fixed number of entities' own equity instruments. Similar definition is there for financial liabilities also. If you recollect, a contract that will or may be settled in entity's own equity instruments is a non-derivative for which the entity is or may be obliged to deliver a variable number. It ends up being a financial liability. Or if it is a derivative, it will or may be settled other than by fixed for fixed. So if it passes the fixed for fixed test of own equity instruments, then it always ends up being an equity transaction. Okay, so this is what we had discussed. Next, we move on to where is my discussions? Okay. All right. Are you kind of recollecting all these discussions that we had? I'm just taking you quickly so that, you are better placed for doing the questions today. Okay. Good morning, Namrata. Good morning, Kaushiki. Good morning. Okay. All right. Then we also saw a couple of exceptions to the variable share or price settlement, where first one is you are having an option price that is adjusted for corporate events like bonus issue or stock split or share consolidation. So in all these cases, the market price gets modified, and pro rata or proportionately the option price also ends up getting modified. So we cannot call that as a variable for variable. Okay, it is fixed for fixed. It is to ensure I am being fair to the option holders. So when that is the scenario, even though it appears to be variable, it's not. So it will not be classified as a financial asset or a liability in such cases. Okay, because it's not, it will be regarded as an equity and not a financial asset or a liability. Coming to the next one, variability that is introduced due to passage of time. This is a certain event that will happen, and therefore we'll end up treating it as an equity. And then finally, you have FCCB. This is a carve out that is there from the IFRS 9. So in your FCCB, if you are going to get a particular number of shares for a price denominated in foreign currency. So the number of shares is fixed. The price in foreign currency is fixed. If this is the case, then you will have to treat it as equity. Though the fact remains that due to exchange fluctuations, the INR value of the shares will differ. But that is because of exchange fluctuations. That is not because of a variability in the options that are offered. Okay, so therefore FCCBs continue to be regarded as meeting the fixed for fixed test. Okay, so this was the initial part of our discussion that we had. Coming to the next unit, where we did the classification and accounting of financial instruments. I'll just rush you through. Then we come to the next topic, the questions, where we will be doing off-market transactions. There were a couple of concepts I had to discuss with you, I told you. So we'll be doing off-market transaction questions. Okay. So our first step that we have to understand is my asset, is my instrument a financial asset or a financial liability or an equity? If it is equity, value at initial recognition, no remeasurement. Why no remeasurement? We don't remeasure our own equity. Okay. Coming to whether it is a financial asset, if yes, then there could be three possible cases of accounting. One is the amortized cost model, the other is FVOCI, and the third one is FVTPL. Coming to financial liabilities, there are two models possible. One is an amortized cost model and the other is FVTPL. So when you talk about financial liability classification, it is a straightforward classification. You have six instruments. You have six instruments which meet the requirement of FVTPL. All others will mandatorily go under amortized cost. So that is fairly clear. Coming to financial assets, you have to perform two tests. If it passes the two tests, it will enable us to decide whether it goes under amortized cost or FVOCI. So the first test is the CCFC or SPPI test. CCFC test, contractual cash flow characteristics test. SPPI means solely for the purpose of principal and interest. So any instrument that meets these two tests is said to, that meets this test, they are alternative names basically. So if it meets this test, we can say that we then perform the next test, that is the business model test. So the CCFC test is basically going to look at whether the investment or the financial asset or the instrument, it meets a basic lending arrangement. Basic lending arrangement requires the lender, the one who gives the loan, the one who makes the investment, to expect returns based on three factors. That is, first is inflation, second is credit risk of the borrower, and the third one is a reasonable profit margin. So suppose I am lending money to an entity that is a AAA denominated bond. For example, you have Tata Capital, which comes up with these AAA rated bonds or AAA minus or whatever be the criteria. So there is a particular loan that is given, a particular rate of interest which is assigned depending on the rating, on the credit rating. So for example, Tata Capital bonds could be 9%. But just for example, you take an entity like Go First or Jet Airways, which issues bonds today. What will be the rating? They would be classified as junk bonds. What would be the rate of interest? Do you think it would be same as Tata Capital? Answer is obviously no. The credit risk there is fairly high. And because of the fairly high credit risk, there is a chance, there will definitely be a certainty that we are going to expect very high returns as compared to what Tata Capital what a Tata Capital bondholder would expect. So inflation, credit risk, and finally a reasonable profit margin. So these three conditions should be met for understanding whether it passes the CCFC test. Okay. Then once we look at the CCFC test, the next test that we are going to do is we will have to check whether it passes the business model test. Okay. Business model could be of two types. One is instruments that are held to maturity, typically like your fixed deposits, for example, or you hold debentures right up till the maturity and get the proceeds on redemption. Okay. Oh, that means you have invested in debentures of another entity. Okay. So this is the held to maturity model. Uh, Typically, these are based on how the management manages the portfolio. Okay. So there could be infrequent sellings. There could be infrequent different transactions compared to the business model. That is acceptable. Okay. What is important is, as a whole, on a material level, what is the transaction that you are commonly performing? So if it is holding till maturity, you will continue to record it as held to maturity. We did the SBI versus ICICI or HDFC example. So there could be another model where you say that, why do I have to pass the CCFC or SPPI test? You don't even test for the business model. They'll directly go under FVTPL accounting. They'll directly go under FVTPL accounting. Is it okay so far? Yes. Anybody has any doubts here? Namrata, Kaushiki, what about the others? Do I have Viraj here? Viraj, Panu. Yes. Yeah. All clear, everyone? You are able to recognize this, because now we move on to the accounting. Now we move on to the accounting. Okay. So that is what we have done. Now, any financial instrument, initial recognition is at fair value. Okay, so that is the basis for doing the accounting. Initial recognition should be at fair value. If you recollect, we had done these questions. Yes. If you remember, we had done these questions. Okay. Where first case, you had the issue price 88,628, face value 1 lakh, redemption 1 lakh, coupon rate 7%, term is 5 years. Okay. So we basically follow an effective interest model. We do not follow the coupon interest model. So if it was to be accounting standards, AS 13, how would you do? You would record the investment made at cost, that is investment account debit uh, to bank 88,628. Your investment would appear at 88,628. Every year you would record income as 7% of 1 lakh. So that comes to 7,000. And the tenure would be 5 years. After 5 years, when you would receive 1 lakh, you would record a gain on redemption of 11,372. Ind AS says this is not a fair presentation. Why? Because you have invested 88,000, you are getting 1 lakh. In between, some coupon is flowing to you. So basically what is happening is, you are earning on 88,628 and not on 1 lakh. You've not invested 1 lakh in the first place. And therefore, the standard tells us that you will have to determine what is going to be my effective interest rate. So my effective interest rate could be done by a trial and error method. In this case, it is 10%. So you have the cash inflows of 7,000 each. At the 5th year, you will be having 1 lakh 7. So the present value of cash outflow becomes exactly equal to the issue price. It becomes exactly equal to the issue price. And therefore, the discounting rate is 10%. So how do we do the accounting? We prepare something known as an amortization table. So here you have opening 88,628. Effective rate of interest. This figure is what actually enters the P&L. And all of you are aware of this. The coupon is basically a payment that is made over the tenure, and the amortized cost is what is the closing balance that is there. So you would be having opening, EIR, coupon, principal, closing in this case. Okay. So the value of the asset gradually moves from 88,628. 1 second. it gradually moves from 88,628 to 1 lakh rupees. Okay, so that is what we will be doing. So we start off with 88,628, end up with 1 lakh. So the interest is recorded at 10%. So if I compare the presentation under Ind AS, I will be ending up with 46,372 as interest income in the P&L over a tenure of 5 years. It is not 35,000 interest under AS, which is 7,000 into 5, and 11,372 as a gain on redemption. It is not the case. Okay. So Ind AS sought to remedy this. Ind AS sought to remedy this. Acha, this is a normal transaction. They've not given the market rate, and therefore we have to take it as it being at market. Okay. Don't get confused. Every student gets confused when they look at coupon rate and effective interest rate. Okay. They will say coupon rate is 7%. Effective interest rate is 10%. The transaction is off market. No, it's not. It is not off market. You could be having a case where there are zero coupon bonds which are issued. A zero coupon bond is essentially a bond that gives zero interest. So it is issued at a very high discount initially, and then the redemption happens at par, or it's issued at a normal discount and redemption happens at a premium. In the span, you don't get any interest. In the interim period, you don't get any interest. So you get the proceeds on maturity itself. You get the proceeds on maturity itself. Now, you cannot say that this is an off-market transaction, because you cannot say that zero coupon bond and EIR are different. Zero rate and EIR they have to be different. That is the accounting mechanism which the standard prescribes. But it is possible that these bonds are traded in the market at the same value at which you are entering into, and therefore there is no gap between the fair value and the proceeds that you would have received. So don't get confused. Don't get confused between coupon rate as well as the EIR. Okay, both are different, is acceptable. It will still be a market transaction, provided the transaction has happened at the market rate of interest, which should be equal to the EIR, EIR and market rate are different, then we have a problem. If EIR and market rates are different, then we are going to have a problem, which we call it as off-market transactions, So what happens is, essentially, my transactions are going to be entered not at market terms. Okay. For instance, I give a loan to my subsidiary company, repayable after 5 years, and I do not charge any interest. Now, are you going to do the same for any third party? Answer is no. Make you karo. And if you do not do it for any third party, that means you have a particular reason for doing this. हाँ बोलोगे वो subsidiary तो है. If it charges interest, that interest remains within the house. It does not go outside, and therefore we are going to regard it, we are going to treat it as an off-market transaction. And Ind AS requires us to do a fair valuation. Why? Because initial booking should happen at fair value. So when you benchmark this against the market rate and determine the fair value, what happens is, the loan which you have given versus the fair value, they are not the same. So when you compare both of them, the debit side will be investment in subsidiary account. I mean, the debit side is going to be loan to subsidiary account debit, X rupees, to bank Y rupees. The difference between X and Y is going to be a balancing figure. X can never be equal to Y because the transaction is off market. So when X is not equal to Y, the balancing figure aayega, that will depend on a couple of things. What couple of things? What is the nature of the transaction? if the transaction is between a parent and the subsidiary, then if the parent has given the loan, the difference is going to be investment in subsidiary. Sir, ऐसे कैसे हो सकता है? You did not collect the interest. Because you did not collect the interest, you have avoided a cash inflow. Avoiding a cash inflow is the same as a cash outflow, and therefore it is an implicit investment that is made in the subsidiary. It is an implicit investment that is made in the subsidiary. On similar lines, you have given a security deposit to your landlord, and that security deposit is repayable back to you after 5 years without any interest, okay? So would you be doing it with everyone? Nah, I'll not do it with everyone. This is my landlord. He's giving me a roof on my head for my rent, and therefore I will not charge any interest. So that means, is it a contractual right to receive cash? वो तो है. In all off-market transactions, the first thing you have to do is whether the instrument is a financial instrument. That means whether it is a financial asset or not. And then you proceed to do the accounting. So here a deposit is a contractual right to receive cash. Therefore, it is a financial asset which has to be initially recognized at fair value. The difference between the two, security deposit account debit to bank, these two values are going to be different. There will be a balancing figure. In this case, it could be prepaid rent, or what we call as ROU, asset under Ind AS 116. So we take it to that line. Then you could be having a case of or kaun sa case tha? Employee loans given to employees at concessional rates. When you give a loan to an employee at concessional rates, what happens is that you are effectively foregoing the interest that you would have otherwise received if the loan was given to a market participant. So you are foregoing that interest. Foregoing receipt of interest means foregoing a cash inflow. Foregoing a cash inflow means a cash outflow. So what is the cash outflow that you are incurring with your employee? Sir, वो employee benefit ही हो सकता है और कुछ भी नहीं. So the balancing figure is employee benefits or prepaid employee benefits, as the case may be. Okay, so these are couple of examples where you could be having. So subsidiary investment, rent deposit, it ends up being ROU asset. In the case of employees, it is going to be prepaid employee benefit expenses or employee benefit expenses, as the case may be. Is it okay? Yes. So now let me just rush you through an illustration which we have already solved. Just a second. We had done this. I hope you are able to recollect. Just checking. Where is that question gone? Rent deposits. We had done this, no? As part of staff welfare measures. Yes. Illustration 25. 1 second, please. Let me just search that. Should be after this. TP May 2020. Okay. Okay. Not able to find it. Let us do this question. Okay. Because with this question, I will end up explaining another concept which we had not discussed. Okay. So now coming to the question and the okay. Right. All of us ready? Yes. So shall we start solving this now? As part of staff welfare measures, Y company has contracted to lend to its employees sums of money at 5% per annum rate of interest. Okay. These amounts are to be repaid in 5 equal installments for principal along with interest. The market rates of interest is 10% per annum for comparable loans. Y lent 16 lakhs to its employees on 1st January 20X1. I think this was a question we had done on Excel. So I will run you through it again on paper and then we shall proceed to look at the new concept which we have to discuss today. Okay. The market rate is 10% per annum for comparable loans. Y lent 16 lakhs to its employees on 1st January 20X1. Following the principles of recognition and measurement, you are required to record the entries for the year ended December X1 for the transaction and also compute the value of loan initially to be recognized and the amortized cost for all subsequent years. You can adopt the following present value factors. Okay. Is the transaction at market or off market? The biggest hint you can get is this one. Off market hint. For any question on off market transactions, this is the hint that will be given to you. Institute आपको बोलेगा नहीं directly that it is an off market transaction, but institute will tell do the accounting. अच्छा, first question first. Is it a contractual right to receive cash? Answer is yes. I'm going to get the money after a period of 5 years. Okay. So therefore it becomes a financial asset. It becomes a financial asset. First point. Second point is it at market or off market? It is off market. Third point. What kind of accounting will you follow? Amortized cost or FVOCI or FVTPL? Answer is you will have to look at the test. Whether it passes the SPPI test, answer is yes. I am holding it to collect interest as well as the principal. The next question that you will have to answer is what is the business model? Are you going to sell off these loans or are you going to hold these until maturity? Held until maturity. So therefore, we have to follow the amortized cost model of accounting. Okay. Now when we come to the accounting, initial recognition should be at which value? Initial recognition should be at fair value. Initial recognition should be at fair value. So we'll proceed to do the, is 16 lakhs my fair value? Answer is no. It is not your fair value because this is not at market rate. It is off market. So we have to proceed to calculate the fair value. Okay. So that is what we are going to precisely do now. Okay. You can write initial recognition of loan to employees. Initial recognition of loan to employees. Okay. Now, since the transaction happens at off-market terms, comma, the loan needs to be recognized initially at fair value rupees 16 lakhs being the transaction price cannot be regarded as fair value. Cannot be regarded as fair value. Is it okay? Yes. So now, five, okay. All right. Interest or what we call as coupon. Principal. Total cash inflow. Discounting factor at 10%. PV of cash inflow. Okay. So the first year I give loan to my employee 16 lakhs. On that, the interest is going to be 16 lakhs into 5%, the coupon. So this is 80,000. Acha, how much am I going to receive as a repayment? Is it a bullet repayment or is it a EMI? Is it an equal repayment every year? Answer is interest is to the amounts lent are to be repaid in 5 equal installments. So this is important. So therefore 16 lakhs divided by 5. So this comes to 3 lakh 20 each year. Okay. So total cash inflow is 4 lakhs. Total cash inflow is 4 lakhs. Now the discounting factors, are they given to you? Answer is yes. So please use that only. 0.909, 0.827, 0.751, 0.683, 0.620. Okay. Acha. What will be the coupon for the second year? That is going to be 16 lakhs minus 3.2 lakhs into 5%. Okay, so that comes to how much? That comes to 64,000. And every year 16,000 will go on reducing because you are paying 3,20,000. 3,20,000 ka 5% is 16,000. So every year your interest goes on coming down by 16,000. So 64, 48, 32, 16. Okay. So total cash inflow is going to be second year 384, third year 368, fourth year 352, and fifth year 3,36,000. Quickly multiply 4 lakh into 0.909. Okay, so this comes to be the present value of cash inflows discounted at 10%. So this represents your fair value. This represents your fair value. Are we clear up till here? Are we clear till now? Yes, please let me know. Any doubts? Anyone? Okay. So now coming to the next part, what is the question asking? It is asking for amortized cost for all subsequent years. That means we have to prepare the loan amortization table. Okay. Year opening. Interest will not be 5%. It will be at the EIR of 10%. Coupon. Principal. Closing. Okay. So year one, what will be your opening? Sir, opening will be 16 lakhs. No, opening is going to be 14,06,272. 272. Acha, effective interest rate is 10%. So 1,40,627. Coupon is 80,000. Principal is 3,20,000. Yes. So this comes to how much? $1146,899. Year 2, 1146,899. 1,14,690. 64,000. 3,20,000. What is the closing balance of the second year? Oh, it should reduce. No, you are paying. वो increase नहीं होगा Kaushiki. It's not increasing. It should reduce. Just check. Okay. $597, $348. Okay. Last year, this is going to be 0. This is 16,000. 3,20,000. Opening balance 305,083. So can I get the interest? Yes. 30,917. Balancing figure. Acha, why do we take it as a balancing figure? Because of the rounding off which has happened. Okay. Otherwise, if you don't do the rounding off and you take it to the exact decimals that are there, then it will perfectly match. Itna difference is acceptable. Don't worry about it. Are we clear with this? Everyone? Yes, that is acceptable. So anybody else, any doubts? Kaushiki, did you understand? Yes. Did you follow? Others, please let me know whether you have understood this or not. Okay, all right. So now let us proceed to do the journal entries. So when is the loan given? 1st January 20x1. 20x1. Okay. So loan to employees, debit. How much am I going to recognize? Why we use market rate as the EIR? Which other rate are you going to use? Okay. See, I have a coupon rate. First of all, understand the premise, understand the concept, then you will follow why we use the market rate as the EIR. See, is it a financial asset? Answer is yes. It represents a contractual right to receive cash. Because it is a financial asset, it must be recorded at fair value. Okay. So a fair value asset, a fair value financial asset would be that asset which fetches 10% interest to the holder of the asset, or in this case, the lender. So that is what is important. Okay. Your earning should equate what the market is giving. Then only we call it as a fair value. Yes or no? What is fair value definition? Fair value definition is that value which is attributable to a transaction between market participants. Yes. So if I have given a 16 lakh loan to my employees, situation demands that I get 16 lakhs back and I earn 10% rate of interest on that. Why? Because it's the market earning. But are you earning 10% on 16 lakhs? Answer is no. मैं तो 5% कमा रहा हूं. I am earning 5% on the 16 lakh rupees. Now, if you are earning 5% on 16 lakhs, it means you are foregoing the remaining 5%. Yes, sir. वो मेरे employees है. It's my employee. I have to take care of them. That means when you give 16 lakhs, you have two things in mind. Collect a little bit of interest, forego a little bit of interest as employee benefits. Yes. But the substance of this transaction is on 16 lakhs, you are not going to get 5%. That means I have to record the loan. I have to record the loan at a value such that it gives the lender a 10% rate of return. Why 10%? Because that is what a market instrument earns. That is what a market instrument earns. The same employee, agar aap loan nahi dete, he would go to the market and borrow it and he would pay 10% interest. So that is your generosity that you are giving it at 5%. So therefore, if I book at 16 lakhs and do the interest working at 10%, my value will never end to zero. My value would never become zero. Okay. Now we have to do a fair valuation of the 16 lakhs loan which I have given. 16 lakhs is not fair. You cannot pass the entry loan to employee account debit to bank 16 lakhs. Nahi bol sakte. Yes. Now I have to change the 16 lakhs. I have to change the 16 lakhs. See, 16 lakhs is fetching me 5%. 16 lakhs is fetching me 5%. Please pay attention now. A similar instrument in the market is fetching 10%. Can you say that I should record it at 16 lakhs? सीधा सीधा आदमी भी नहीं बोलेगा, who does not know financial assets, instruments chapter, even that person will say, yeah, then your loan is not going to be 16 lakhs. You tell me, forget all the calculations which we did. You tell me, if I have to record it at fair value, will it be higher than 16 lakhs? Will it be lower than 16 lakhs? Or will it be equal to 16 lakhs? Whatever be the scenario, understand that the amount receivable is constant. That is, cash inflows are fixed. 3 lakh 20, 3 lakh 20, 3 lakh 20 each year towards principal, 80, 64, 48, 32, 16 towards interest. So whatever be the scenario, my cash inflows are fixed. So now you tell me, what I give is 16 lakhs. What I get is fixed. But market interest is 10%. Now you tell me, simple maths, it's not financial assets. You are supposed to earn more. You are supposed to earn more than what is contracted. So therefore, if I'm supposed to earn more, two things are fixed. Rate of interest is fixed. Amount receivable is fixed. What will change is the initial recognition value. You tell me that initial recognition will be higher, lower, or equal to 16 lakhs. Simple maths. Okay. Forget the table वगैरह जो भी हमने बनाया, forget that. Will 16 lakhs, can I record at 16? EIR 10%, amount receivable will be the same. Should I record more than 16? Interest rate 10%, amount receivable tak पहुंच जाएगा. Okay, so what I am trying to tell is 16 lakhs, 5% gives you a particular amount X. 16 lakhs at 10%, X is fixed. So if I have to get a higher return as compared to the market, this value is going to obviously be lower. This value is obviously going to be lower. Number one. So वो 16 lakhs तो नहीं होगा. It is going to be less than that. Now, coming to the process. I am not earning 10%. That is the sum of everything. Okay. 16 lakhs I gave. I'm getting a defined cash inflow. I am not earning 10% out of this. That means what? You are not at market terms. You are not at market terms. But what the standard tells? Standard is saying, see, when I give 16 lakhs with this 5% coupon, you are basically doing two things. You are entering into a lending arrangement and you are doing something for your staff. ये दो चीजें आप कर रहे हो. It is integrated into one. But the fact remains, it is given in two, it is two objectives that you are achieving. If you give a completely interest-free advance, if you give an interest-free advance, then also, are you doing the same thing? Yes, you are doing the same thing. So therefore, what the standard wants is, the first time you pass the entry, that time only, segregate these two things. Don't show it as 16 lakhs. If you show it at 16 lakhs, you are not going to segregate this. But the reader should know that I have given a loan at a lower rate of interest. The investor should know that when he has invested in the company is giving it to the employees at a lower rate of interest. Usko pata chalna chahiye. He should know that his money is being put to employee advances use and it is generating a lower interest than the market. That means there is a component of staff welfare which is included in this, which should come out. And that is why we do a fair valuation of this transaction. Fair valuation ke liye kya chahiye? What do I need is two things. One is initial recognition is an outflow, money going out of the entity. And you are going to get an inflow. Now, what inflows are coming to you? They represent your, what do I say? They represent your returns in rupee terms. They represent your returns. They represent the earnings. They represent the return in rupee terms. That return should be equivalent to 10%. That return should be equivalent to 10%. Why? Because it is the market rate. Because it is the market rate. The same amount you go and give in the market, you will expect 10%. And therefore, what you are getting is fixed. That is not changing. But I have to somehow change this 16 lakhs so that what I receive is equivalent to 10% of what I have invested. Are you able to follow? Yes. So therefore, we do a discounting at 10%. This discounting is market rate. This discounting is my market rate. Okay. Always it will be your market rate. Okay. So year 1, 2, 3, 4, 5. I do the working and I get a value of 14,06,272. That means what? Today's date, if I give 14,06,272 and I get the cash flows in this manner, then I can say that I have earned 10% on the transaction. I can say that I have earned 10% on the transaction. Acha, is it okay? Yes. Anything above this is not fetching me 10%. Anything below this is not fetching me 10%. So 14,06,000 is going to be your fair value of the lending arrangement. Is going to be fair value of the lending arrangement. Okay. Now we do the EIR working. We then do the loan amortization table working and arrive at the closing value. Okay. Now the question that arises is, in some cases, we do IRR calculations. Yes, we do IRR calculations in some cases. Okay. Why that will come? I will come to that because it happens due to transaction costs. Typically, this is the reason we do it. Transaction costs. Okay. Why? Why? Because market rates do not have transaction costs. Transaction costs are entity specific. Remember Ind AS 113. Don't forget the two standards are closely linked to each other. In Ind AS 113, when we were determining the transaction, when we were determining the fair value, what did we say? Consider transportation cost because it changes the characteristic of the asset. But do not consider transaction cost because transaction cost is entity specific and not market specific. It is transaction specific and therefore transaction costs were excluded from the purview of Ind AS 113 fair value determination. But here we do have a transaction cost which is entity specific. Usko main chhod nahi sakta. And that is why there your EIR will change. I'll come to that later. I will come to that later. Don't worry. Okay. As of now, my market rate is going to be my EIR because in this case, there is no transaction cost. So understand this. In this case, there is no transaction cost. Okay. And because there is no transaction cost, EIR will be equal to the market rate. EIR will be equal to the market rate. Okay. Are you clear with this? Yes. Sure. No doubts. No doubts. Okay. Namrata has said it means if I have given 14,06,272 in the market at 10% interest rate, then also see, if you give 14,06,272 in the market, look at the amortization table. If you give 14,06,272 in the market at 10% rate of interest, with the manner of payments that are outlined here, yes, with the payments outlined here, then the amortization table turns to 0. The amortization table turns to 0. That means what? On a 14 lakh loan, with the stream of cash inflows, your earning rate is 10%. Your earning rate is 10%. Okay. 5% is not having any relevance as far as return is concerned. It is not a return. It is just a repayment of an obligation. Uska ek calculation. That's it. Okay. All right. So if you give 14 lakh in market at 10% interest rate, then also I get interest that I now earn at 5% rate of interest. No. Don't say that 5% is a rate of interest. वो rate of interest नहीं है. It's not a rate of interest. It is a mere coupon. This is what we were going wrong under the AS regime. We give a value, we give an amount, and the coupon rate is determined on a totally different amount. First of all, in AS regime, how would I account for this? Loan to employee account debit to bank 16 lakhs. Coupon every year, it would be loan to employee account debit to interest income, 80,000, 64, 48, 32, 16. And finally, bank account debit to loan, you would get the full amount. What was the problem in this? Problem in this is reader is unaware, does not know that this is a transaction where the company is earning less than it should have earned. Yes. See, you invest, suppose company does not have any assets or liabilities in its books. Only thing what is there is share capital 16 lakhs. You have invested that. So I will have bank 16 lakhs, share capital 16 lakhs. This 16 lakhs gives it as a loan to employee at 5%. Whereas in fact the market rate is 10%. When you see the balance sheet, you will see loan to employee 16 and you will see loan to employee 16 given to employees, and there in the terms of the loan has to be disclosed. You will see that it is given at 5%. You will be livid as an investor. आपको गुस्सा आना चाहिए. You should be angry because you will tell the company loan देना ही था. If you had to give a loan, at least give it market terms. I did not give it to the company so that you give it at a lower rate of interest. Loan dena hi tha, then I would have given it in the market and earned 10%. Why am I going to put it in the company to earn 5%? Ye to mera nuksan ho gaya. That is what the investor will be livid at the transaction. So you have to present the information saying that this loan is given to employee, and as a part of my staff welfare measures, I have reduced the rate of interest. And therefore, loan to employee will appear at 14 lakhs. The difference between 14 and 16 is going to be regarded as a staff welfare. And now when the investor looks at the balance sheet, it will look something like this. share capital 16 lakhs, loan to employee 14 lakhs, prepaid employee benefit 1 lakh, about 2 lakh rupees roughly. So now the investor is going to feel relieved that, okay, वो मेरा employee है, I have to take care of him, and therefore prepaid staff welfare is acceptable. And the other side is 14 lakhs will definitely fetch 10% interest and become zero at the end of 5 years. So that data is going to give a lot of comfort to the investor. I'm not hiding any information. In fact, this is the fairest accounting that I have seen till date. Is it okay? Yes. What is the difference between a coupon and interest rate? Interest is what accrues in the P&L. Interest is what accrues. You have invested 14 lakhs something as an advance. On that, what you earn is the interest that accrues. Coupon is merely a payment. Okay, उसका interest के साथ कोई संबंध नहीं है. In Ind AS, coupon is just a payment. That's it. How you calculate, why you calculate is totally your prerogative. But coupon is merely a payment. It does not hit the P&L at all under Ind AS. AS mein coupon was hitting the P&L. But in Ind AS, it is what your investment fetches in the market. That is what should hit the P&L. That is what should hit the P&L. Is it okay? It makes sense. It makes sense. Okay. See, if I speak about the balance sheet which I was talking about, under the AS regime, the balance sheet would look something like this. Suppose you are the only shareholder, equity share capital 16 lakhs, loan to employee 16 lakhs at 5%. This is what would be visible. Under the Ind AS regime, this is what is going to be visible. $16 lakhs, loan to employee 14 lakh 6,272. This will be at 10%. And then the investor will see and understand that, oh, 10%, that means market rate is achieved. And then I will have prepaid EBE 1,93,728. And then once he sees, he will understand that, okay, so some prepaid expenses are there. It will be over the next couple of years. Alternatively, you can take it just as EBE and start hitting your P&L entirely. वो भी कर सकते हो. You can do that also. Okay. What is more clear? Investor will be very happy with this data. So we have achieved what is fair presentation by doing a fair valuation of the asset, by doing a fair value of the financial asset. Is it okay, everyone? Yes. All right. Any doubts? Kaushiki, clear? Namrata, clear? Viraj, clear? Panu, clear? Yes. Janvi is not there today. Okay. All right. Fine. तो ये हो गया मेरा. See, this is a question that will hit your examinations. This and convertibles, most important. And in the 10 classes that we had, I have spent maximum time for this. Okay. So loan to employees. This will come at 16 lakhs. No, this will come at 14 lakh 6,272. To bank, सर मेरा तो एक्चुअली 16 लाख जा रहा है. हाँ तो जाने दो. सो द डिफरेंस 1,93,728. What is this difference? Sir, this difference is prepaid employee benefit expenses debit. Alternatively, you can take it as EBE and hit it in the P&L immediately. Okay. That also you can do. That also you can do. Is it okay now? Yes. All right. What they have asked? Record entries for year ended December X1. Okay. So 31/12/20 Now we have to record the first year's transactions. Okay. So interest earned, is it 80,000 or 1,40,000? What is the interest that is earned? Is it 1,46,27 or is it 80,000? इतना सब डिस्कस किया. What is my interest earned? बता दो. $1,40,627. 80,000 is payment, as Kaushiki rightly said. 80,000 is payment, 1,40,000 is interest. You cannot say 80,000 is your interest. No. Reader will say 80 divided by 1 lakh divided by 14 lakhs is less than 10%. वो पागल हो जाएगा. Okay. So you have to show it by numbers that what you are earning is 10%. And that is 1,40,627. Okay. So loan to employees debit 1,40,627 to interest income. Which ultimately hits your P&L. Which ultimately hits your P&L. The question will only be on Ind AS, Namrata. They cannot ask AS. Okay. It's purely Ind AS. I expect you to be experts in AS by now. Okay. I expect you, and correctly so. All of you are experts in accounting standards. Okay. Okay. So loan to employees account debit 1,40,000 to interest income 1,40,000. And then payment will happen. अरे yes or no? Will the payment happen? हाँ जी, payment क्यों नहीं होगा? So कितने का payment होगा? Only 80,000. Answer is no. Payment will happen of coupon plus principal. So therefore 4 lakhs. So the entry is going to be bank account debit 4 lakhs to loan to employees 4 lakhs. Loan to employees 4 lakhs. Are we clear with this? Are we clear so far? Good, good, good. Viraj. Very well. Okay. Others, are you clear? Kaushiki, Namrata, all clear? Yes. Okay. Yes, it is. It is interesting. Yeah. So now coming to the last entry, Employee benefit expense account debit to prepaid. If you had to treat it as prepaid, then end of every year, you will have to take it to the P&L proportionately. So 1,93,000 divided by 5. So that comes to 38,000 something. Okay. So that will go to employee benefit expense. Account debit to prepaid EB. This institute has done no harm in it. It's not wrong, but you can alternatively take it to EBE also. Okay. Alternatively, you can take it to EBE as well. Okay. I don't see anything wrong. Okay. Because मैंने आज सारा benefit दे दिया. Okay. So that could be the perception that you could have. Okay. But institute has taken it to prepaid EBE and therefore we will have to record it. Okay. Over the tenure of the loan. So 5 saal mein you do an expense recording. So EBE account debit to prepaid 38,000 something will come. That is what you will have to recognize. Okay. So this takes care of the illustration which we had done. As far as the illustration is concerned, we have solved. Are we clear with this? Everyone is clear. So now let us proceed one step further. This is what we had discussed. मैंने कुछ नया नहीं सिखाया अभी तक. This is all what we had discussed. Now I'm going one step further. Employee बोलता है, okay. So let us now proceed. This is not in the question. As far as question is concerned, we are done. Okay. Now, so the entry will be 31st December X1 EBE. Don't use this abbreviation in exam. Okay. To prepaid EBE 38,746. 38,746. Okay. This is 193,728 over 5 years. दूसरा साल आ गया 31st December 20X2. So what am I earning? I am earning interest of 1,14,690, making a payment of 3,84,000. So let us pass that entry. Loan to employees debit. $1,14,690 to interest income. 1,14,690. EBE debit to prepaid expense. $38,746. And last one is payment. Bank account debit to loan to employees. कितना होगा? That will be 3,84,000. Sorry, not 3,84,000. I'm sorry, my mistake. Oh yeah, 384. Okay, fair enough. Yeah, 3,84,000. Okay. So end of year 2. Balance of loan 8,77,589. Prepaid EBE 1,16,236, which is essentially 193,728 into 3 by 5. Okay. One lakh 16,236. Okay. So as on this date, there is this balance appearing. Is it okay? From here, this entry onwards, we are doing the extra concept. We are doing the extra concept. Okay. So now on 31st December 20x2, that is at the end of the second year, employee prepays 3,20,000. Okay. एक installment वो extra दे देता है. Okay. He pays an extra installment because employee तो यही सोचेगा, see, I am going on paying my interest at the rate of, for employee interest is 5%. Don't go wrong in that. Okay. Is not applicable. Ind AS is not applicable in his case right now. So वो बोलेगा यार मेरे को 5% देना पड़ता है. So what I will do is I have surplus cash. So therefore I will prepay an installment. So वो क्या करता है? He prepays 3,20,000. He prepays 3,20,000. Now you tell me, this is not what we had covered. This is a fresh discussion. Okay. Now you tell me, think and answer. Okay. Wait and answer, pause and answer. Okay. What will be the journal entry for this prepayment? What will be the journal entry for this prepayment? Think and answer. What will be the journal entry for this prepayment? Exactly. Okay. Any other answers? Kaushiki gave the answer. Namrata, Viraj, what do you guys think? Come on, answer. Panu, what do you think if you are watching? Okay. All right. So everybody is giving the answer bank account debit to loan to employee 3,20,000. This is what everybody is giving me the answer. Viraj, this is the entry everybody has given. Acha. कुछ सोचा आपने before thinking about this entry? You should think about the implication of the transaction first. Okay. I don't want exact calculations. Because obviously you are going to learn that now. But when you think about this transaction, एक दो चीजें should have struck your mind. सर कौन सी चीज है सर? हमें तो बस दिख रहा है कि पेमेंट हो रहा है. I only see that a payment is coming to me. So bank account debit and employee is clearing his loan. Understand now. What was the tenure of the loan? 5 years. He has prepaid an installment. So therefore, 5 का कितना हो गया? 4 साल हो गया. 5 years has become how much? 4 years. Now, what will be the implication of the reduction in the amount tenure? What will be the implication? First one, if I take 3,20,000 directly to the loan balance, if I take 3,20,000 directly to the loan balance and put it in the amortization table, मेरा amortization table हिल जाएगा. My amortization table which I have prepared will go for a toss. Why? Because amortization table is a structured table, starting with opening balance, ending with closing balance of 0. It is a structured table. That structure is getting ruptured. That structure is getting destroyed, damaged, senseless, because you are passing this entry. If I pass this entry here, where is my amortization table? If I pass end of year 2, right? So instead of 3,20,000, if I write it as 6,40,000, prepayment is happening at end of year 2 only, na? So if I write it as 6,40,000 and then I proceed to do the calculation, you want to see what will happen? Let us see what is going to happen. Okay. कोशिश करते हैं, देखते हैं क्या होता है. आपको खुद ब खुद समझेगा कि वो सही नहीं हो रहा है. ओके, सो लेट अस कैलकुलेट. यस, ओके, सो ₹5,57,589. $55,759. Now, what is going to be my coupon for the third year? It will be 16 lakhs minus 320 minus 640 into 5%. Into 5%. So therefore, 16 lakhs minus 320, 640, 5%. 32,000. Payment will be 3,20,000. So 557,589 plus 55,759 minus 32,000, 3,20,000. This is going to be 0. Closing balance is going to be 0. Okay. Now, last installment will come 3,20,000. Yes. Last coupon is going to come 16,000. And then the balancing figure is going to be your interest. $74,652. And now, what is the rate of interest that you are showing? 74,652 by 261,348. this comes to some exorbitant rate of interest of 28.6%. Are you earning 28.6% or are you earning 10%? मेरे को फैक्ट बताओ. ओके, डिड यू अंडरस्टैंड द टेबल? मैंने वही किया जो आपने बताया. यस, I did the same thing that you also did. Okay, that you advised. Bank account debit to loan to employee. So I have taken the entire impact of the loan in year 2. What is the prepaid amount? Okay. And then I prepared my amortization table for years 3 and 4. End of year 4, it should become 0. So if I do that and calculate the EIR, it comes to a very high rate of 28.6%. Is this making sense? Is this making sense? No. In year 4, the reader will say you made 28.6%. Then why are you doing business? Put all money in that 28.6% only. Does not make sense. Does not make sense. Okay. So this is one problem which we could possibly end up facing. Okay. There is a very huge balance in the last year. Okay. Which is getting written off as effective interest. Okay. So therefore, not acceptable. Reason number 1. So first one is amortization table gets distorted. Acha. Second one. There was a prepaid employee benefit expense component. वो कितने साल के लिए था? सर वो 5 years के लिए था. It was for 5 years. अच्छा. Now if my employee repays it, prepays an installment, can I say that prepaid tenure, which was originally 5 years, has come down to 4 years? Can I say that? See, 1,93,728 was my original balancing figure. Yes, this was my original figure. What was the tenure of this? Sir, tenure of this was 5 years. That means you would be providing staff welfare to your employee for 5 years. Yes or no? Now, by virtue of this prepayment, what is happening? Sir, loan gets repaid in 4 years. Yes. If loan gets repaid in 4 years, that means you are giving welfare to your staff only for 4 years. Yes. But initially you gave it for 5 years. Now it has come down to 4 years. So can I say that the 5th year welfare which I was going to give of 38,746, I no longer have to give that. And therefore, this prepayment of 3,20,000 can be said that it is going towards the loan and it is also going towards reducing the staff welfare expense. It is also going towards reducing staff welfare expense. Are do we agree or not? Reducing in this case the prepaid staff welfare expense. Are we able to understand? Yes. Reducing the prepaid staff welfare expense. Yes or no? तो हमको ये split करना पड़ेगा. We have to do this split. Yes. Yes. So now I cannot do a straightforward bank account debit to loan to employee 3,20,000. वो मैं नहीं कर सकता. So now what you have to do? You will have to again calculate the present value of the loan based on the remaining 2 years. 2 साल बीत गए. You have done a prepayment. So remaining tenure is 2 years. So again do a present value calculation. Again do a present value calculation. Okay. So now what the standard tells is at end of year 2, beginning of year 3. At end of year 2, beginning of year 3. Now, value of loan revised. Initial balance कितना था? Initial balance was 8,77,589. So now I have to calculate the revised balance. So how do I do that? Year 1. This is originally year 3. And then 2. This was originally year 4. I am standing at the end of year 2. That means originally year 3 is now year 1 for my discounting. Originally year 4 is now year 2. Year 5 will not come because this is prepaid amount. So therefore loan gets extinguished in the 4th year itself. So 5th year is not going to come. Okay. Interest. Okay. Principal, total, EIR 10%, present value. Okay. So now how do I calculate my, this is again not interest, we call it as coupons. Okay. So now this will be 16 lakhs minus, I have paid 3,20,000 in year 1, 3,20,000 in year 2, 3,20,000 prepaid, into 5%. So 16 minus 320 minus 320 minus 320 into 5%. $32,000. $32,000. And then principal 3,20,000. वो तो दोगे ही. So total payment being made is 3,52,000. Discounting factor at 10%. This is end of year 1. So 0.909. 0.909. $3,19,968. 3,19,968. Next, rate of interest, I mean coupon is going to be 16,000. 3,20,000. 3,36,000. 826. 2,77,536. $5,97,504. This should be the balance of your loan at the end of year 2. At the end of year 2. Okay, the present value at the end of year 2. Are we clear with this? Yes. Are we clear with this? Yes. Have you noted this down? So end of year 2, the balance in your loan account should be 5,97,504. 5,97,504. Yes, now we proceed further. Loan balance original. What was my original loan balance? 877,589. After prepayment, it should be 597,504. Okay, I have a query. Why is the discounting factor taken as 0.909? Where am I standing? I am at the end of year 2. So end of year 3 means 1 year from year 2. That is why 0.909. Originally year 4 means 2 years from year 2. And that is why 10% discounting for the second year. Is it okay? Yes. I am at the cusp. I am on year 2 and I get a prepayment. And now I have to find out what will be my loan balance for the remaining 2 years. Okay. All right. So this comes to how much? $2,80,085. Reduction in loan 2,80,085. So therefore, when there is a prepayment, journal entry on prepayment, bank debit 3,20,000 to loan to employee. वो कितने से कम हो रहा? 2,80,085. And where will the balancing figure go? 39,915. 39,915. What is this 39,915? Can somebody tell me what will be this 39,915? Yes. Okay. Namrata, you understood why the discounting factor is 0.909? Yes. Did you understand why discounting factor is 0.909? Yes, that is nothing but prepaid EBE reduction to prepaid EBE. Yes. Namrata, clear. Viraj, clear. Kaushiki, clear. Why have I credited prepaid EBE? This is because in the last year, I'm not giving any welfare. वो loan दे देगा at the end of 4th year. So 5th year, there is technically no welfare which is being given to him. And therefore, I will have to reverse that. Okay. Now, you can also check that the prepaid EBE that I was reversing every year is 38,746. So henna it's almost kind of equal. And therefore 39,915 is going to be credited to my prepaid EBE. So therefore, what is your closing balance revised? Revised loan balance. Year 2. $597,504. Revised prepaid EBE balance year 2. This is going to be, what was my initial balance? 1,16,236 minus 38,746. So this comes to how much? Not 38, sorry. Minus 39,915. So 1,16,236 minus 39,915, 76,321. This is how you will do the presentation. Spread over balance 2 years. Only 2 years is left. Why 2 years? Because you will repay the loan in years 3 and 4. Year 5 तो कुछ रहेगा नहीं. So spread over balance 2 years. That is year 3, year 4. Okay. Year 3 and year 4 is what you are going to spread this amount. Are we clear with prepayment? Yes. Are we clear with prepayment? Is the concept understood? Yes, Viraj, Kaushiki, Namrata. It's just you 3 guys who are there, I suppose. So did you understand? You want me to do year 3? Year 3, what you want? You want me to do the table for the year 3? Yes. So we'll do the amortization table. Amortization table. What do I do for year 3? You want another prepayment in year 3? Year 3 will be based obviously on the revised amortization now. Okay, so this is value of, okay, so let us do the amortization table. Revised. Year opening, EIR at 10%, coupon, principal, closing. Okay. So I do the revised amortized table for your working. Okay. So basically, I think you want to check whether it now comes to 0 at the end of year 4. Okay. So let us see year 1. This is originally year 3. Okay. So opening balance is now how much? 597,504. EIR will be how much? 59,750. Okay. What will be my coupon rate? Well, I have paid 3,20,000 for years 1, 2, and the third year also I prepaid it already. So 9,60,000. So this will come to 32,000. Okay. Principal is 3,20,000. So this comes to 597,504 plus 59,750 minus 32,000 minus 3,20,000. 305,254. Year 2. Originally, it was year 4. 305,254. 16,000. 3,20,000. This will be 0. 30,000. Yes, it almost fits in. Okay. Almost equals to 10,000. Almost equals to 10,000. Is it okay? Yes. So now the fresh accounting will happen based on this. So in year 3, what will be the entry that you are going to pass? Loan to employee account debit to interest 59,750. Coupons that you collect, bank account debit to loan 3,52,000. So closing balance khud ba khud aa jayega. Okay. The same thing you will do it for year 4 also, where interest will be 30,746 and prepayment will be 3,36,000. Are we clear with this? Yes. Okay. Good. So that takes care of prepayment. That takes care of prepayment. So we'll write a small summary for this. Yes. Very important. Off market prepayment convertibles, early redemption. We've done early redemption also, if you remember. I'll be revising, just touching that now. Okay. But prepayment, I hope it's clear. We'll write a small summary and that should take care. Then we'll do one more illustration for practice. Okay. I'll be extending the class today like last time. Okay. थोड़ा टाइम मिलता है आपके साथ स्पेंड करने के लिए because it's a holiday. Yes, so we'll do it a little longer. Okay, all right. Now, prepayment of loan at off-market terms. I'm talking about part prepayment. Okay. I'll give a break after writing the theory. Yes, I'll give a break. Prepayment of loan at off-market terms. So first one, determine carrying amount of existing loan. Reference original amortization table up to the date of prepayment. Okay. In our case, that balance was how much? 877,589. In our case, it was 8,77,589. Second, calculate revised carrying amount of remaining cash flows at the revised terms, that is after prepayment. Discounted at same EIR. See, the question will try to confuse you by giving a different EIR on the date of prepayment. Okay. The question will try to confuse you by giving you a different EIR on the date of prepayment. Don't take that revised EIR. Okay. Don't take that revised EIR. You'll get confused. See, today we'll be hopefully doing derivatives, splitting of embedded derivatives. In some cases, we take revised EIR. आपको याद है, we did early redemption. In early redemption, we did the revised EIR on the date of early redemption because that was the interest which I would forego on account of early redemption. आपको याद है, did we have done early redemption, right? In early redemption, the interest foregone is taken at revised EIR, not the original EIR, because that was what you would forego if early redemption had to happen. So the initial split that was done in the case of early redemption, of the early redemption amount, I would split between equity and the financial liability component. That split would happen based on the revised EIR, because that was what you would forego. First point. But in this case, your loan is an asset and your rate of interest is originally what you have contracted with. That means on that date, you have entered into a contract, and on that date, the fair value interest was 10%. So even if they give a revised EIR here, don't consider that. Continue to do the accounting at the discounted, continue to do the discounting at the same original EIR of 10%. Okay. So in this case, it came to how much? 597,504. $597,504. Third step. reduction in loan balance. Step 1 minus step 2. In this case, it comes to how much? 280085. 280085. Are we able to correlate? Yes. Prepayment minus reduction in loan. So in our case, it was 3,20,000 minus reduction in loan 2,00,085. So this equals adjustment to, it could be prepaid EBE or it could be adjusted to ROU asset if it is a security deposit, or it could be a deferred grant, as the case may be. Okay. Number 5. Okay, we'll just write a couple of points for this. In our case, this came to rupees 39,915. The balancing figure is adjusted against the hidden benefits. If it was a deferred grant, okay, if it was a deferred grant which you had received from the government, okay, then it would be that case. Okay, so it depends what is the nature of the financial instrument that you are having. Okay, so kuch bhi ho sakta hai. So this is a generalized note, it's not related only to this, kuch bhi ho sakta hai. Okay, the balancing figure is adjusted against the hidden benefits as due to the prepayment, comma, such hidden benefits cannot be what do we say, cannot be enjoyed? Cannot be enjoyed in the period originally envisaged. In our example, foregone benefits in year 5. Okay, foregone benefits in year 5. All right. Is adjusted against the hidden benefits, cannot be enjoyed in the period originally envisaged. Fifth step, after above effects, comma, loan is amortized over remaining period new amortization table and loan is amortized over remaining period and revised prepaid EBE in our example 76,321 will be amortized written off over remaining period. Okay. See, that's what I said, Namrata. Why deferred grant? It depends on the nature of the transaction. Okay. So suppose you have received a transaction where the government has given a subsidized loan. Government has given a loan that is what you can say that is having a low rate of interest. So this is in Ind AS 20 typically. So when it is a low rate of interest, there are two components. One is a loan and second is a grant that you have received. Okay. So think it of like this. Suppose you set an industrial unit in a backward area. And when you set up a unit in a backward area, what happens is government gives you a loan. Suppose it gives you a loan of 10 crores at 2% rate of interest. It gives you a loan of 10 crores at 2% rate of interest. Now, for setting up a unit, if you had to take a loan, you would be incurring interest at 8%. Government gave you 2%. So what are you going to do? You are getting 10 crores. But is it actual 10 crore which you are getting? No. You are getting what we can say, you will have to take it at the 8% discount rate, determine what is the fair value of the loan which you have received. There will be a balancing figure. That balancing figure is grant. That balancing figure is a grant amount. Okay, so it works something like this. Have you written this down? Have you kind of written this down? I'll just explain the deferred grant because she asked it 2-3 times. Okay. So if it was a subsidized loan, the entry would go something like this. Bank account debit, ₹10 crores to financial liability at fair value. This would be, let us suppose, 8 crores to deferred grant. This would be 2 crores. And then this 2 crores is what will be amortized to income. A ठीक opposite है. So this would be deferred grant debit to income. Now, if you prepay it, suppose the tenure of this is 10 years and you prepay 2 installments. That means last 2 years, I will not be able to enjoy the government grant and therefore we will adjust it against deferred grant account. Okay. तो इसके वजह से वो adjustment वहां पे आएगा. But that adjustment mentioned in Ind AS 20, I suppose, is exactly what is the concept under financial instruments. Okay, ठीक है. So this is how you will be doing it. Okay, have you understood now? Namrata, did you follow? Yes. All right, fine. So this is how you will be doing it. And this puts an end to prepayment of loan. Prepayment of loan. Okay. All right. We take a break now. It's about 9:15. We take a break for 10 minutes. We resume at 9:25 and we'll extend the session definitely. Okay. I have lot of things to tell you. Okay. So we extend the session and continue. Okay. See you after 10 minutes. Break. All right. So welcome back. So I hope you have understood in detail about prepayment. Yes. Okay. Let me see question 39. Okay. All right. Now, okay, let us come to question number 2. We'll do 1 or 2 questions on prepayment, so that kind of, cements the concept for you. Wheel Company Limited. Yeah. So come to question 2. This is the same page, 12.208, comprehensive illustrations. Wheel Company Limited has a policy of providing subsidized loans to its employees for the purpose of buying or building houses. So subsidized loans, that means off market, to its employees for the purpose of buying or building houses. Mr. X, who is the executive assistant to the CEO of Wheel Company Limited, took a loan from the company on the following terms. Okay, so what are the terms? Principal amount 10 lakhs, interest rate 4% for the first 4 lakhs, 7% for the next 6 lakhs. Slab wise interest is there. Start date 1st January X1, tenure is 5 years. Prepayment full or partial prepayment at the option of the employee. The principal amount shall be recovered in 5 equal installments and will be first applied to the 7% interest bearing principal. Okay. Accrued interest shall be paid on an annual basis. X must remain in service till the term of the loan ends. So यहाँ पे assumption नहीं होगा. It will be correct to only put it under prepaid EBE. Okay, prepaid EBE is not going to be an assumption. It is fixed because employee should remain in service. So the benefits are being given over the service of the employee. That is the tenure of the loan, and that is why it has to be prepaid EB. In illustration 1, it was not necessary because वहां पे assumption ऐसा था नहीं. But here the employee has to stay for the tenure and therefore prepaid EB. The market rate of a comparable loan is the market rate of a comparable loan available to Mr. X is 12% per annum. Following table shows the contractually expected cash flows from the loan given to X. Okay. Just forget this table for the time being. Mr. S prepays 2 lakhs on 31st December X2, reducing the outstanding principal as at that date to 4 lakhs. Okay. So now 31st December X2, there is a prepayment. Okay. There is a prepayment. Okay. Now we will have to calculate. We will have to calculate the recognition of the loan. Okay. Don't look at the table. There is a prepayment of rupees 2 lakhs. Okay. Of rupees 2 lakhs. Okay. So as of now, itna kafi hai. Don't look at the remaining things. They have given record journal entries considering the requirements of Ind AS 109. So we'll do that. Okay. Now let us start. Will not refer to the cash flow movement, this, that, etc. Whatever is given. It is creating more confusion than necessary. Okay. All right. So what is the first step? Determine the carrying amount of the existing loan. So this is question 2, page 12.208. Okay. So first one is fair value of loan at initial recognition. Okay. Year, coupon, principal, total, discounting factor, 12%, present value. Okay. So year one, principal amount is 10 lakhs. Loan repaid in 5 equal annual installments. So that comes to principal repayment of 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs. 5 ho gaya? Yes. Now coming to the interesting part, that is the coupon. 4% for first 4 lakhs, 7% for next 6 lakhs. 4 lakhs into 4%, 6 lakh into 7%. So that comes to how much? 4 lakh into 4% is 16,000. 6 lakh into 7% is 42,000. 42 plus 10, 52 plus 6, 58,000. So total is 2 lakhs 58,000. Discounting factor at the rate of 12%. So 1 divided by 1.12. They've given the discounting tables. No. So we'll only calculate. So 1 divided by 1.12. So 0.8929. We'll write all the discounting tables factors. 0.7972. 0.7118. 0.5674. Okay. So now 2,58,000 into 0.8929. 230,368. Okay. Second year. Acha, the first payment will be out of which principal will be applied first to the 7% interest bearing principal. Okay. So 4 lakhs will be like that only. 4 lakhs into 4% plus 6, out of which 2 is repaid. So 6 lakhs nahi rahega. It will also come to 4 lakhs. So 4 lakhs into 4%, 16,000. 4 lakh into 7%, 28,000. 28 plus 16. So that gives you 44,000. $44,000. So 244,000 into 0.7972. 1,94,517. Third case. Another 2 lakhs is paid plus 2 lakhs into 7%. So 16, 2 lakh into 7% is 14. So this becomes 30,000. 2,30,000 into 0.7118. 163,714. Fourth year. The 7% would be fully repaid. So 4 lakh into 4%. So this comes to 16,000. 2,16,000 into 0.6355. 1,37,268. 2 lakhs into 4%. 8,000. 2,08,000. 0.5674. So total this up 230,368, 194,517, 163,714, 137,268, 118,019. 8,43,886. 8,43,886. Are we clear with this? Yes. This is the fair value at initial recognition. This is the fair value at initial recognition. Any doubts? Okay, all clear. So now what is happening? They have given all these things. It's not required. We have already calculated ourselves 58, 44, 30, 16, 8. So we have calculated this. Okay. And then the prepayment event that has happened, that is also given to you. Okay. So now we will have to do the accounting. Now, coming to our steps. Did I determine the carrying amount of existing loan? Yes. I have the amortization table. The prepayment is happening on which date? On 31st December X2. On 31st December X2. Okay. तो लोन मैंने दिया था कौन से डेट को? 1st Jan X1. So this will be, 31st December X1. And this will be 31st December X2. This will be 31st December X2. Is it okay? So now let us prepare amortization table for original loan. Loan amortization table. Okay. Original. Is it necessary to prepare the whole amortization table? Answer is no. If you want, you can prepare, but at the most what will happen is it will become 0. But what are we interested in is, as at 31st December X2, what is the loan balance? That is what we are interested in. तो हम उतना ही बनाएंगे जितना जरूरी है. ठीक है? We will do only what is necessary. So here I will be having year opening, EIR at 12%, payment, closing. So year 1, 2, 843, 886, EIR at 12%, EIR at 12%, 101,266. Payment that is happening in year 1 is 2,58,000. So therefore 843, 886, 101,266 minus 2,58,000. 687, 152. 12% of this 82,458. 2,44,000. So 687, 152, 82,458 minus 2,44,000. How much does it come to? 5,25,610. So this is the first step. Original balance. Original balance on the date of prepayment. On the date of prepayment. Are we clear with this? Yes? Okay. So now what is the next step that we are having? So determine the carrying amount up to the date of prepayment. I got this. Now I will have to calculate the revised carrying amount on the date of prepayment. That is on 31st December 20x2. So we'll do that now. Yes, let us do that. So third one is fair value of loan after prepayment. After prepayment. Okay. So year 1. I have prepaid the loan. Earlier the tenure was 5. Now it has become 4. So I have prepaid at the end of year 2. So this is originally going to be, how did I get here? 4 lakhs into 4% plus 4 lakhs into 7%. But now I'm making another payment of 2 lakhs. So it will be 4 lakh into 4% plus 1 second. I have prepaid this. No, I won't be here. I will be here. Okay. I would have prepaid. I would have paid 2 lakhs year 1, 2 lakhs year 2, and 2 lakhs is the prepayment amount. So total there is a prepayment of 6 lakhs. So therefore my interest that will be coming is going to be only on the 4% slab. So this will be 4 lakhs into 4%. So that comes to 16,000. Next, principal. Principal. 2 lakhs. So that comes to total of 2 lakh 16. Discounting factor at 12%. 0.8929. Present value. 1,92,866. Okay. Then second year, originally year 4. So 31st December 20x4. Here it will now be 2 lakhs into 4%, 8,000, 2 lakhs, 2 lakh 8,000, 0.7972. 1 lakh 65,818. So 358,684. Are we clear with this? Yes. Are we clear? At the end of year 2, the loan would be repaid off. The loan would be repaid off. Okay. So if I look at this, I got revised carrying amount. So then the next step is reduction in loan balance. Therefore, reduction in loan balance. How much is it? 5,25,610, 3,58,684. 525,610, 358,684. So 1,66,926. So I got this also. What is the prepayment being made? 2 lakhs. So therefore, adjustment to prepaid EBE. I am paying 2 lakhs, out of which 1,66,926 is going towards the loan. Since it is loan to employee, the balance is adjusted against the prepaid EBE. So that is 33,074. So this step also is taken care of. Okay. All right. So shall we start passing the journal entries? Have we understood? Yes. 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 All right. So now we proceed to pass the journal entries. Now we proceed to pass the journal entries. सबसे पहले You don't need to calculate the revised amortized table, but just if you want for your own satisfaction, you can do that. Okay, just आपके satisfaction के लिए we can have amortization table after prepayment. So year 1, this is actually 31st December X3, and year 2, 31st December X4. Opening 358,684. EIR at 12%. So 358,684 into 12%, 43,042. What is the repayment being made? Repayment being made is 2,16,000. So repayment $2,16,000, closing. So 358,684, 43,042, 2,16,000, 1,85,726 into 12%, 22,287. So sorry, this is a balancing figure, my bad. This will be 0. And prepayment is 2,08,000. So 2,08,000, 185,726, 22,274. Okay, it's almost coming the same. It is almost coming the same. Only 13 rupees difference is there, which is due to rounding off. So my figures are correct. And now we proceed to calculate we now proceed to record the journal entries. Okay. So 1st January X1, loan to X debit to bank. Acha, loan to X is recorded at 8,43,886. To bank, you are actually paying 10 lakhs. So the difference is what is going in prepaid EBE. $843,886 working note 1. Okay. Next. 31st December X1. Loan to X debit 101,266 to interest income. $101,266. Working note 2. P&L. Next. 31st December 20X1. Coupon paid. Bank account debit to loan to X. 2,58,000 2,58,000. Okay, so this is the principal and interest paid. Yes, and then EBE. So EBE debit to prepaid EBE. Divided by 5 years. $31,223. 31,223. Are we clear? Yes. Can I expect you to pass the journal entries for year 2 at this stage? Can I expect you to pass the journal entries for year 2? Yes. Could you do that for me? Journal entries for year 2 खुद कर सकते हो? All right. So you will be having interest. You will be having repayment. And you will be having prepaid entry. You will be having the prepaid entry. These 3 entries you will pass. And then we get the prepayment that happens. PRE, prepayment that will happen. Okay. So the prepayment entry is going to look like this. Bank account debit, 2 lakhs. 2. Loan to X, 166,926. 33,074 to prepaid, EBE, prepaid EBE, 33,074. Okay, and then could you do the accounting based on the new amortization table? That should be doable. Okay, that should be doable. That should be doable. Okay. Did we follow? So remaining journal entries, you please pass. We have kind of done the whole problem. Okay. बस बाकी 2 साल के लिए you will have to record interest, repayment and prepaid. That's it. And then it ends. Okay. Viraj, did you follow? Yep. I'll give that. I'll give that. Okay. Kaushiki, I'll give that. ठीक है. So ये हो गया हमारा bank account debit to loan to X to prepaid EP and do the remaining entries. It's straightforward, pretty straightforward. Okay. All right. So that takes care of loans at off-market transactions. Off-market transaction is discussed fully. Prepayment impact also is discussed fully with one extra illustration and one illustration that is solved with you. So that takes care of prepayment also. And note also is given to you. So prepayment is done. Off market transactions, we have done it entirely in totality. A question hai, there is one question that I want us to do right now, that we'll be doing it right now. It is, I won't say different or difficult, but thoda sa typical question hai. It's a little bit of a typical question, I must say. So we'll do that one question before we wind up the discussion on accounting for these loans and all that. Okay. So let us come to, okay. May 22 exam question. This had come in the examination. So May 2022 exam question. Okay. Question 6B. Question 6B. Okay. All right. Let us have a look at this and then we shall proceed. X Limited has made a borrowing from RGD Bank for rupees 20,000 at a fixed interest of 12% per annum. Okay. Loan processing fees were paid additionally amounting to rupees 1,000 and the loan is payable in 4 half-yearly installments of 5,000 each. Details are as follows. Loan amount 20,000. Date of loan starting 1st April 2020, ending on 31st March 22. That means it is a tenure of 2021, 21, 2020, 21, 21 and 22. Okay. So this is what is your tenure. Repayment of loan starts from 30th September 2020. That is to be paid on a half-yearly basis. Installment amount is 5,000. Interest rate is 12% per annum. Interest charge to be charged and paid quarterly. Interest to be charged and paid quarterly. Upfront fees is 1,000. That is the same transaction cost which is mentioned. Compute the interest to be charged to the statement of profit and loss every quarter over the period of loan. EIR is 16.6% per annum. Okay. See, in this case, am I given the market rate? Am I given the market rate? Am I given the market rate here? Market rate as such is not given separately, but they have given effective interest rate. And unless otherwise mentioned, I have no reason to believe that this transaction is off market terms. Okay, so if nothing is given, the transaction will always be at market terms. The transaction will always be at market terms. It will be very difficult to calculate the fair value separately using 16.6% because interest is paid quarterly, repayment is happening half yearly. It is going to play around with your lives. Okay, so therefore, don't even try to do that. Okay, if they have not given that it is at off market terms or they have not given the market transaction, the simple way is जो transaction हुआ है that is at market terms, वो समझना है, and that takes care of the entire transaction. Okay, that takes care of the entire question. Many students they fumble here. Okay, एक तो already fumbling would have started. ये payment quarterly भी हो रहा है. Principal is paid half yearly also. हम कैसे निकाले? So that is what you have already approached the question with that problem. And second problem is you will fumble because market rate is not there. So don't need of fumbling. If data is not there, very good. You can assume what you want to assume. Okay. So be realistic with your assumptions though. EIR is 16.6. That itself is the market rate. There is no other option you can elect for. Okay. Don't even sit calculating, because if you sit to prepare that table what we just now have prepared, you will end up spending half an hour 45 minutes. वो table कभी बनेगा ही नहीं. So don't even try to do that. straight away you jump on the solutions. Okay. So now this is question 6B, I suppose. May 22. Okay. So unless given otherwise, transaction will be at market terms. Hence, transaction price equals fair value equals कितना है 20 minus 1. Okay, 19,000. So this is what is the fair value. Now let us start. Opening, okay, okay, closing. So now the repayments are scheduled every quarter. ये कोई prepayment वगैरह का question नहीं. It is a straightforward question. It is just a straightforward question. How would the loan be accounted is what they have asked. That's it. Okay. So quarter 1, opening balance is 19,000. That is 21,000, 20,000 minus 1,000. So this is 20 minus 1, 19,000. Okay. It is on a quarterly basis that you are charging also and paying the coupon also. So therefore, EIR will be 19,000 into 16.6% into 3 by 12. So that comes to how much? $789. $789. Coupon is going to be calculated on the face value. That's what they have given. 12% per annum. This is interest rate, means this is your coupon. And this is always on the face value. This is always on the face value. Are we clear? Yes. Are we clear? So therefore, this will be $20,000. 600. Principal, nothing paid because it is paid half yearly. It is paid half yearly. So 19,000 plus 789 minus 600. $19,189. Okay. Now 796. Interest will again be 600 here, coupon. And now you are going to pay the principal. You are going to pay how much? You are going to pay how much? Repayment of loan from 30th September on a quarterly basis. So I have taken description of repayment of loan starts from 30th September on a half yearly basis. So how many years am I having? 2021, 21, 22. 2 years, 4 half years. So each half year means 5,000 each half year. Okay, so this is 5,000. $14,385. Next. 14,385. कहाँ चला गया? $597. Coupon rate. What will be the coupon rate? It will be 15,000 because 5,000 is already paid. So 15,000 into 12% into 3 by 12. 450. So 14,385, 597, 450. 14,000, 532. Just a second. I think something is wrong here. No, it's okay. It's okay. 14,532. Okay. Coupon. This will again be 450. Nothing is repaid. And here I do a repayment of 5,000. Are we following the table? Yes. Are we following the table? It's becoming a one-way traffic. Yep. Please tell me. I'll just be back in a minute. Try to complete the table. Let us see. Try to complete the table. Okay, so let us start. Let us continue. Sorry. So 9685. $402, and here the interest will now be on 15 minus 5. 10,000 coupon into 12% into 3 by 12. 300. 9685. 9787. Quarter 6. You should have a clear idea of where this table ends up. It should end up to 0 at the end of the second year, that is the 8th quarter. At the end of the second year, that is the 8th quarter. $9,787 into 0.166 divided by 4. 406. Here it will be 300, and then another 5,000 will be paid. Next. Absolutely right, Kaushiki, that's right. 4893 quarter 7, 4893 into 203. I have paid, so this will be coupon 5,000 into 12% into 3 by 12. So that comes to 5,000 divided by 4. 150. 4893 plus 203 minus 150. 4946. Quarter 8. 4946. This ends up at 0. And finally, this is 150. There is a 5,000 payment that I make here, and the final EIR comes at 51504946 204. You can just check out of curiosity. 4946 into 16.6% divided by 4. It comes to 205. 1 रुपया चलता है यार. 1 rupee is fine. Okay. So that takes care of the entire table for you. So this is how the amortization table will be prepared in this case. Okay. All right. Are you guys lost? 1 rupee chalta hai, madam, chalta hai. Yes. So I had to do this one question for you because it was resulting in a kind of different amortization table. Okay. So so you prepare the workings on a quarterly basis because interest is charged and paid quarterly. Okay. And the transaction is at fair value. Very good. So, and the transaction is at fair value. So therefore, initial recognition will be at 20 minus 1, that is 19,000. That is, it will be at 19,000. Okay. So that takes care of this one question जो pending था, करने की इच्छा थी, वो कर दिया. That takes care of May 22 examination question. Okay, fine. Now, okay, and then how many marks for this question? बहुत ज़्यादा नहीं था. If you see, it is a 5-mark question. It's not anything great. Okay. Compute the interest to be charged to the statement of P&L every quarter. We did that over the period of the loan. Bas, that's it. Nothing else is there. 5 marks question. Okay. So quite simple, nothing difficult, nothing. Prepayment is done, and accounting for equity I have discussed. Reclassification I have discussed. Okay. So that takes care of this part. Now what is left is, Kaushiki had asked one question, which is, why do we calculate EIR using IRR in certain cases? Okay, so that is because of the transaction costs which are there. Okay, that is because of transaction costs. The presence of transaction costs is going to create a difference between the EIR and the market rate. Okay, so transaction cost is a specific cost which you will have to factor it, In fact, if you recollect the extra problem that I have shared with you. Yes, 1 second. Where is the extra problem? Okay. Okay. See, we had discussed this question. Issue price is 88,628. Transaction cost is 1372. Face value is 1 lakh. Redemption is 1 lakh. We have to now proceed to calculate the effective interest rate. We now have to proceed to calculate the effective interest rate. Here we are going to end up using the IRR technique. Why am I forced to use the IRR technique here? Because one is you are not given the market rate. So therefore we have to take it that the transaction is happening at market rates. There is no other option. Okay. And for the effective interest rate to calculate, we have to use the IRR. So whenever you have effective interest rate or you have a redemption happening at a premium, in all these cases, we will be constrained to use the IRR technique if you are not given the EIR separately. Okay. If EIR is given separately, you can take that EIR and do the working. You'll get the same answer. Okay. So that takes care of your query. And that takes care of this part. Now, what do I discuss? 1 second. Okay. So this part is done. This question is done. Okay. Okay. All right. This question also we could do. Just a second. I have to see what else is remaining important to discuss. 29, 30, 37. Okay. Okay, 37 is done. Okay. The questions are spread across various sources. So that is why just hunting whether any important one is left out to be discussed with you. I haven't found anything important except 32 and 33. Okay. 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 All right. So market rate is done. Yes, yes. So these are the topics. Those are topics which I have left out. Means left out as in I have to do that. They are totally fresh topics. Okay. What I'm looking is what I have already taught you. In that, if I have missed out on any concept that I need to discuss, like the prepayment one, we had actually done off market earlier. So I had to just discuss the prepayment with you. These are topics which I'll be discussing that, but whether I'm left with anything specific, okay. Okay, okay. MTP, what is this? 43. Okay. Convertibles, we have solved quite a number of questions. So there is no doubt in that. Okay. So now we come to an MTP question. Okay. We now come to an MTP question. Okay. Simple question, but because it is there, I would just want us to do it. Okay. All right. So, question, kahan gaya yaar? Where did that question go? 3B. Question number 3B. Yes. QA Limited issued 10 lakh 8% long-term bond A series of rupee 1 each on 1st April 2016. The bond tenure is 3 years. Interest is payable annually. Interest is payable annually on 1st April each year. The investors expect an effective interest rate. The investors expect an effective interest rate of 10% on the loan. So this is kind of a market rate. Okay. QA Limited wants you to suggest suitable accounting entries, for the issue of these bonds as per applicable Ind AS. Consider the discounting factor as 3 years, 10% discounting factor to be 0.751315 and 3 years cumulative discounting factor 2.48685. What is the principal value of the bond at initial recognition? Number one. What is the present value of the interest payment to be recognized as part of the sale price? Okay. What are the proceeds of the sale of the bond to be recognized at the time of initial recognition, and what is the accounting entry to be passed? Okay. I want you to read this question and kind of try to solve it. Let us see what you are going to get. Okay. It's not a difficult one. A little bit, you may get stuck up somewhere. I sincerely hope you should not get stuck anywhere. Okay. But you may is what I feel. Let us see. Okay. Just try this question. Try this question. Initial recognition, how much should I recognize? And if there is a gap, where should it go? Okay, these two questions, you just tell me. How am I going to recognize it? Okay. Tell me. All the rates, everything is given to you. So just check it out. What do you guys think? Give me the journal entry on initial recognition. Kaushiki, just check your working. That answer is not right. That answer is not right. Check your working. Okay. Yes. Give me the entry on initial recognition. Namrata, give me the entry. Viraj, give me the entry. I'm waiting for answers. Okay. So what will be the journal entry, Kaushiki? That answer is right, what you have given. What will be the journal entry? Okay. Fine. Fine. Okay. Namrata, any answer? Viraj, any answer? Okay. Okay. Oh, Janvi is there. Okay. All right. Fine. 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 Okay. So now just let us try to understand. Okay. QA Limited issued 10 lakh of 8% long-term bond A series of rupees 1 each. This statement, 10 lakh of rupee 1 each. What is this? Is it issue price or is it face value? Very simple question. This 10 lakh of rupee 1 each, is it issue price or is it face value? मेरे को सिर्फ इतने का आंसर दे दो. Janvi also gave similar answer to what Kaushiki has given. Namrata did not give the answer. Tell me, this 10 lakhs, what is this? Is this the face value, issue price, fair value? What is it? Okay. Kaushiki is saying it is both. Janvi, what do you think? Is it face value or issue price? It is only the face value. It is only face value. ये issue price नहीं है. Sir, how do you know that? See, the investors are expecting an effective interest rate on the loan at 10%. That means if this bond had to have a rate of 10% effective interest rate, only then it would be coming to rupees 10 lakhs. But let us try to understand what is going to be the fair value of this. What is going to be the fair value of this? Let us try to understand. This is MTP. May 2019, question 3. Let us understand. See, I am having 8% 10 lakh bonds of rupee 1 each. Okay. और क्या बोलता है? Bond tenure is 3 years. 3 years and interest is payable annually. EIR is 10%. Okay, EIR is 10%. Now, let us understand. Fair value is equal to present value of future cash flows. Future cash flows क्या आएंगे? See, 10 lakh is the rupee value. Coupons are there at 8% into 2.48685 plus the principal will be redeemed. So 10 lakhs into 0.751315. So this comes to how much? This comes to 1,98,948 plus 7,51,315. So this is rupees 9,50,263. Now, what are the answers I am getting is, bank account debit. This is not the right answer, but I'm just telling what is the answers I'm getting. $9,50,263. Something kind of this is what I'm getting. If I look from it from the perspective of the holder of the bonds, they are getting investment in bonds debit, okay. So this is what is the problem. This is what is the problem. You are telling that issue price is 10 lakhs. All the understanding that I have received, at least whoever have responded, are telling me that face value equal to issue price equal to 10 lakhs. Okay. All those who responded have given the correct answer to this, that this is the fair value. Everybody has given correct answer, 9,50,263. Now, my question to you is, what is this 10%? The investors expect an effective interest rate on the loan at 10%. The investors are expecting an effective interest rate at 10%. ये क्या है? This is market rate or is it not the market rate? See, you are QA Limited. QA Limited wants you to suggest the suitable accounting treatment. So you are the issuer of bonds. Issuer of bonds means in your books you will be having the financial liability. Okay. So therefore, this is not what we are asked. We are asked this. Now, if I issue these bonds at 10 lakhs, will my investors get 10%? Answer is no, because they are going to get 10% only if it is 9,50,263. Are yes or no? They are going to get 10% only if it is 9,50,263. Yes or no? This rate, the investors expect an effective interest rate at 10%. This itself represents the market rate. See, it is an effective lending arrangement. Think at it from the perspective of the investors. Suppose investors came to you for a basic lending arrangement. They will look at the inflation risk. They will look at the credit risk. They will expect a reasonable profit. And then they come to the rate saying that it should be 10%. So now you are going to them with a document saying that we will give you 10 lakh bonds. The face value of this bond is 1 rupee each. And therefore, please subscribe. The investors say, look, you are giving us 10 lakh rupees. bonds. So we have to pay you some amount. Let us say that amount is X. We will pay that much amount, which is going to give us a rate of 10% on our investment. The company says, fair enough. So you will be taking the bond at an effective interest rate of 10%. Okay. That means you give me 10%, you give me 10 lakh bonds. These are bonds which have an 8% coupon for a period of 3 years. And at the end of 3 years, you are going to pay me you are going to return the principal also back to me. There is no redemption, no transaction cost, nothing. So therefore, I expect a 10% return. And you have calculated just now saying that if I take 9,50,000, 250, 260, wo jo bhi figure hai, how much did you get? 9,50,263. So the investors will say, you give us 10 lakh worth of bonds. Okay. In return, we are going to give you only 9,50,263 because that is what is my expectation. The market expects that this company's investments should generate an effective interest rate of 10%. And it can generate an effective interest rate of 10% only if the issue price is 9,50,263. It will be 9,50,263 issue price. It cannot be 10 lakhs because 10 lakh does not give the effective interest rate of 10%. So what the company is going to do, the company will say, take this bond and do the accounting at 9,50,263. The bond is not getting issued at 10 lakhs. That is where all of us have made a mistake, because 10 lakh is not the issue price here. The issue price here, don't go into intermediate. Don't think, sir, Companies Act aisa bolta hai, waisa bolta. I am not concerned right now about Companies Act. I am not concerned right now about accounting standards. I am concerned about Ind AS. What is happening? 9,50,263 should build up to 10 lakhs over a period of 3 years with a coupon rate of 8%. This is possible. This is possible only if I do the initial recognition at 950,263. But why do we do initial recognition at 950,263? Because that is effective interest rate. हाँ, but वो market rate किधर है? लिखा तो है. Investors are expecting a rate of 10%. Who are these investors? अरे, that is the market only, no. अरे, वो market नहीं है तो क्या है? You come out with an issue of bonds that will go to the investors. Investors expect 10%, means that effective interest rate is the market rate for all practical purposes. And therefore, I have to do the accounting at 9,50,263 only. And gradually, I will build up the liability up to 10 lakhs. Gradually, I will build up the liability up to 10 lakhs. Are we clear with this? Yes. Is it okay? Janvi, did you follow? Kaushiki, did you follow? So on the initial date, what is the journal entry that you are going to pass? What is the journal entry that you are going to pass? You will pass the entry, bank account debit to bonds 9,50,263. 9,50,263. Is it okay? Yes. Is it fine? Now, if bond is issued to a... I didn't get your question, Kaushiki. What are you saying? Bond is issued to a subsidiary or a holding? In that case also, can we take the fair value as issue price? Please clarify your question. Bond is issued to holding. In that case also, see, don't mix up two things. When you say holding subsidiary, lesser lessee, or employees, in all these cases, there is an off-market element that is involved. In this case, that is not an off market element. In this case, EIR, sorry. In this case, EIR equals to the market rate. When EIR equals the market rate, then what does it mean? Fair value equals the issue price. Fair value equals the issue price. If it is off market, fair value and issue price will never be the same. Fair value and issue price will never be the same. You are probably getting confused because what is there in front of you is 10 lakh bonds at ₹1 each. तो हमको बचपन से देख रहे हैं सर 10 लाख दिखता है, लायबिलिटी में 10 लाख शुड कम, and then you will say Companies Act does not allow per issue of bonds etc at a discount, so therefore we are getting stuck. वो ऐसा नहीं है, it's not how it happens. Okay, so therefore how am I going to do the accounting? I am going to do the accounting taking 9,50,000 वो जो भी है 263 as the issue price. Liability also is 9,50,263, and gradually I will build up the liability to 10 lakhs in the third year, and at the end of the third year I'll pay it off and extinguish the liability. Are we clear about this? Yes. Are we clear about this in totality? Yes. 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 Since EIR equals to the market price, issue price is the fair value. Yahan pe it is working opposite. See, in all the problems that we did till now, we were given the issue price. Humko issue price malum tha. In all the questions we did till now, we were given issue price. We had to check the fair value and then say whether it is off market or on market or at market terms. Most of the cases it was off market, so the balancing figure we could attribute to some reasonable assumption. In this case, we determined the fair value, but issue price is not given. What is given is the face value of the bonds which are issued. Face value has no concept in accounting right now. It is no longer a legal form of accounting. It is a fair value basis accounting. And in the fair value based accounting, face value does not have any place. So in your AS regime, we used to follow legal form. क्या फॉलो करते थे? लीगल फॉर्म. लीगल फॉर्म में आपने डिबेंचर इश्यू किया 10 लाख, दिखाइए लायबिलिटी 10 लाख. सर बट दैट इज पेएबल आफ्टर 3 years. तो क्या हो गया? टुडे ऑन टुडेज डेट you are going to you have issued debentures worth 10 lakh face value. 10 lakh face value should appear in your books today. Ind AS बोलता है सर ऐसा नहीं है. It's not like this. Today I can book it at any rate, at any price, provided I do an effective interest rate working and adjust for the coupons so that at the time of redemption it should touch 10 lakhs. Itna ho gaya. Ind AS says very happy you have given a true and fair view. Otherwise 9,50,000 issue price, 10,50,000 kya dikhaoge? You will show it as a discount. It is not a discount. वो interest hai. It is the implicit interest you are offering to the investors in the form of a higher redemption value. What are you doing? You are taking 9,50,000 to 10 lakhs. Basically, you are redeeming at premium over issue price. Yes or no? You are issuing at a premium over issue price. Don't say premium on face value. Face value से मेरे को कुछ लेना देना नहीं है. I am issuing it at a premium over the issue price. This premium, did it suddenly take birth on the last day? No. This premium, was it born on the first day? Answer is no. This gradually accrued over the 3-year tenure. And that gradual accrual, I have to show it in the reporting over the 3-year period. Otherwise, I'm not giving a true and fair view. Are we clear about this? Yes, sure. I was sure that you would make a mistake. Because I also made a mistake when I did this question the first time. Okay. Not that you cannot be correct when I'm wrong. I'm not saying that. Okay. But the fact is, our thought process is so much ingrained with what we have learned that applying new concepts requires unlearning of those concepts. I'm not saying you are wrong. I'm just saying that we are unable to unlearn what we have already learned. It's a dramatic change in the accounting that we are seeing right now. Okay. ऐसा कभी accounting देखने को ही नहीं मिलता था. Okay. So that unlearning process is a key to getting your Ind AS concepts correct. Okay. So don't worry. As of now, you have to read the question 2, 3, 4, 5, 10 times if you want to see whether there is any proceeds of issue, transaction cost. Ye sab na, these are all keywords which are there in the question. Is question mein, there is no issue price only. They are saying issue 10 lakh bonds of rupees 1 each. Bas. We have arrived at a conclusion that issue price is 10 lakhs. वो तो दिया ही नहीं है क्वेश्चन में, and therefore we cannot conclude that the issue price is 10 lakhs. Are we clear with this? Yes. Viraj, did you follow? Janvi, did you follow? Kaushiki, Namrata, did you follow? Yes. Bolo. Have we understood? Yes. So what will be the solution to this? We can just run through the solution that they have given and then, but I think this is only the question part. Okay, no problem. We'll write the answer here. Okay. Okay. So let us now proceed to write the answer. You can please ignore this scribbling. Okay. This is looking at it from the other perspective. Okay. We are looking at it from the counter perspective. So therefore, we can write it like this. We got the fair value. We do not know the issue price. In all the questions we did till now, issue price was given to us. Okay. So you can write here. Since EIR is the market rate of interest, comma, fair value determined will be the issue price. First one, bank account debit 950 263 to interest expense debit to bond liability 10%. And then third one is bond liability to bank. This is the coupon 80,000. Okay, 10 lakhs into 8%, 80,000. Yes, have you noted down? So to give you perspective, what is the principal value of the bond at initial recognition? Well, the principal value of the bond at initial recognition, this is 7,51,315, the principal portion. What is the present value of the interest payments? This is 1,98,948. And what is the proceeds of the sale of the bond? What are the proceeds on the sale of the bond to be recognized at the time of initial recognition? दोनों का total 9,50,263. 9,50,263. Is it okay? Yes. All right. Let me check, Janvi. Oh, don't worry. We are there to solve. Okay, let me check what Janvi has had to say. Just give me a minute. I think. Just a second. Where is the problem? Okay, MTP. QA Limited issued 10 lakh of 8% long-term bond A series. Okay. 1 second, please. Let me just check. This is mock test March 19. Just give me a minute. Let me check. 2019 May answers. Okay. All right. 3B. Okay. We are getting the same one, no? 9,50,263. The solution also is saying the same thing. Option, the first one is 7,51,315, which I have calculated. Yes. Then it is saying second answer is 1,98,948. And the third option, it is saying 9,50,263. So that is right. I don't know where you are checking the share option and all. Okay. 1 second. Okay. 2A. That is 2A. 2A I am yet to do. Janvi, that share option is a separate question. Okay. So share option, I'm doing it right now. The discount on bond is not required. Okay. So I saw your answer that share option is a separate one. The question, I'm going to do it right now. Okay. So just wait. In fact, that is the next question I'm going to pick up. Okay. So now coming to this is B1. The share option is in B2. Okay. QA Limited has also issued 10 lakh of 8% long-term B series of rupee 1 each on 1st April 2016. Okay. All right. The bond tenure is 3 years. Interest is payable annually on 1st April each year. However, the bond holders of the series are entitled to convert the bonds to shares of rupee 1 each on the date of maturity instead of receiving the principal repayment. Interest rate on a similar bond without conversion is 10%. QA has requested you to suggest the following for this type of an instrument. What is the entry to be passed on issuance and what is the entry to be passed on conversion? Okay, so this is the conversion option that is there. Okay, so now how do we tackle this question? Okay, is it a convertible instrument? Yes, is it now a convertible instrument? The first case is not a convertible instrument, so I cannot have an option there. Okay. The second case is a convertible instrument, and therefore, what do we do? I have a bond that has the features of both convertible as well as non-convertible as well as redeemable features. Yes, the bond holders are entitled to convert. Is it optional or is it mandatory? It is optional at the option of the bond holders. Okay. So now we will have to do the accounting. How do I do the accounting? Let me take the same rates of interest. Has issued bonds of 10 lakh of rupees 1 each. Interest is this thing. Okay. QA has limited. Okay. Has also issued. Okay. Now let us start. Let us start solving this question. Yes. Problems. Okay. Now, this is 2. Initial recognition of liability component is equal to the 80,000 only you are getting. So 80,000 into 2.48685 plus 10 lakh into. Okay. So this comes to how much? This comes to 9,50,263. This is the liability component. This is the liability component. And now let us look at this. QA Limited has also issued 10 lakh of rupee 1 each bonds on 1st April 2016. Bond tenure is so much. Interest is payable annually on 1st April each year. The bondholders are entitled to convert the bonds to shares. Interest on a similar bond without the conversion option is 10%. This data is a non-convertible data. Now, the question is, QA has requested you to suggest the following. Now, here, am I given the issue price? First question, is issue price given? Is issue price given to you? Yes. Is issue price given to you? Is issue price given to us? No, नहीं दिया यहां पे. अच्छा, तो here if issue price is not given, can you say it is 9,50,263? Can you say it is 9,50,263? ये थोड़ा dicey है. It becomes a little bit dicey. But you tell me, is it going to be 9,50,263? Should the issue price be 9,50,263? Okay, two answers are saying we can assume it to be 9,50,263. One is saying we cannot. Two answers are saying we cannot assume 950. One is saying we can assume. Okay, what is 9,50,263? What is this? This is present value of cash flows, assuming redemption will happen. That is pure liability component. That is a pure liability component. In fact, not assuming, it is given that redemption will happen. You can see here, it is interest rate on similar bond without conversion option is 10%. Okay. So yahan pe we did this working. So 9,50,263 value aa gaya. In the previous case, in the previous example, this line was not given. The bond holders are entitled to convert to shares. This line was not given there. So I took it as issue price. Why? Because what you are giving is only a bond, and they are expecting 10% interest on that. So therefore you will issue them at a discount. You will tell them, dekho, I can give you 80,000 per annum, and on redemption I will give you 10 lakhs. Okay, but they will say we expect 10%. Okay, so in that case you pay me 9,50,263. I will pay you 80,000 per annum and 10 lakhs at the end of the third year. In this case, the company will say, look, I am giving you 80,000 per annum. I am giving you 10 lakh rupees at the end of the third year. I am also giving you an option to convert it to equity. दोनों instruments में you are giving something extra in the second instrument. What is that something extra? That something extra is the equity option which you are giving. It is the equity component of the financial instrument that you are offering to them. Tomorrow, if the company's share price rises, the holder can definitely say, yaar, I don't want your money. Your share price is doing so well. Give me shares in your company. If the share prices are performing badly, I can tell them your shares, they are waste. You give me the money. So I am giving them the option to choose. I'm giving them the option to convert. I'm giving them an equity option. And therefore, can I still say that 9,50,263 will be the issue price? Answer is no, we cannot. In that case, what do we have to do? We have to come to a reasonable assumption. And reasonable assumption क्या बोलता है? Issue price is going to be 10 lakh into rupee 1 each, that is 10 lakhs. Because और कोई data नहीं है. There is no other data in the question that is giving me a hint about the issue price. In the previous problem, it was not required because all I was issuing was a bond, a mandatorily redeemable interest oriented bond, nothing else. It was a pure financial liability. And therefore, वहां पे क्या था? I was not having any second thought about my accounting. I knew that 9,50,000 is the issue price. I am going to give it for 9,50,000. Is it okay? Yes. अरे समझ में आ रहा है अपने को? Are you able to understand the distinction between the two questions? The first question, कौन सा है ये? 3B1. 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 Pure financial liability. इसका वैल्यू 950, 263. 3B2. Financial liability plus option to convert. इसका वैल्यू 950, 263. I cannot assume that this value is 0. If you book at 9,50,000, you are saying there is no option to convert only. Or फिर you are saying both the instruments have the same value. And therefore, reasonable assumption क्या बोलता है? Take the issue price as 10 lakhs. So what is going to be this? You have always done this. This will be the equity component. 49,737. Is it okay? Yes. So look at it as a same instrument. One is a pure financial liability. Another is a liability with an option to convert. When I taught you the convertibles the first day only, did I not teach you like this? That I have a pure financial liability. I have a convertible instrument. So convertible may say you remove the financial liability. What is left is the value of the equity component. Don't go to value equity component separately because that is going to have a lot of bias. यही कहा था मैंने उस दिन. Yes, I told you have a contract, you have an option, you have a paper where you are having only liability. You have another paper where there is an option to convert. Join both the papers, that gives you the third one. Third का value मालूम है, that is the issue price. First का value पता है, that is the liability. From the issue price deduct the liability, जो बचता है, that is the value of the option. That is the value of the option. Yes, we had done it that way. ये question में they have taken the same concept, but they have kind of उसको normal खाने के वजह से they have taken it in a circular manner. Okay. Janvi, are you clear? Yes. Janvi, are you clear? Kaushiki, are you able to understand? Viraj, are you able to follow? Yes. Are you able to follow, everyone? Yes. Okay. All right. So that takes care of this question. Okay. All right. Now there is one more similar tricky question that I want to do, and that is very tricky actually. Okay. It's like it's difficult to comprehend also, but let us try to do that. Okay, ये MTP का question हो गया. I hope you guys are noting it down. Okay. Equity is a residual interest. That's right. Okay. So coming to the next one, RTP May 2022 question. Okay. All right. Yes. This one. Let us pick up this question. An interesting one. Thoda confusion hai, but I think you'll be able to, you'll be fine. On 1st April 20X1, entity X issued a 10% convertible debenture with a face value of rupees 1000 maturing on 31st March 2X11. Okay, fine. Jab hoga, tab hoga. The debenture is convertible into ordinary shares at a conversion price of rupees 50 per share. Okay. All right. Interest is payable yearly in cash. On 1st April, to induce the holder to convert the convertible debenture promptly, X reduces the conversion price to rupees 40. Earlier it was rupees 50, now it is 40. That means number of shares that will be allotted to the bond holder is increased. Okay. If the debenture is converted before 1st June, that is within 60 days. The market price of entity X's ordinary shares on the date the terms are amended is rupees 80 per share. How will the revised terms be accounted? How will the revised terms be accounted? Okay. Tell me, are we having a convertible debenture? आंसर द क्वेश्चन, फटाफट आंसर दो, आपको अपने आप प्रॉब्लम समझ में आ जाएगा. डू वी हैव अ कन्वर्टेबल डिबेंचर? Yes. Do we have a convertible debenture? Yes. Now, convertible at whose option? Convertible at whose option? Is it convertible at option of the holder or is it convertible at option of the issuer? मेरे को सिर्फ ये एक बात का मुझे आंसर दे दो. Is it convertible at the option of the holder or is it convertible at the option of the issuer? Okay, so Namrata says it's convertible at the option of the holder. What about the others? Kaushiki, Janavi, and who is the other one? Viraj. What do you guys think? Convertible at whose option? Convertible at whose option? Holder. Clear है? कहां से पता चलता है? From here. On 1st April to induce the holder to convert promptly. That means लगाम किसके हाथ में? Who is controlling the choice to convert? It is the holder. To induce him, to ensure that he converts, we are giving something extra. Okay, something extra kya? Reduction in the conversion price. Now, how will the revised terms be accounted? How will the revised terms be accounted? Are you able to understand? Yes, are you able to follow? Bolo, how will the revised terms be accounted? It's a very, very different question. It is a very different question. Okay. Is it a compound financial instrument? Is it a compound financial instrument? Yes. Itna bata do. Is it a compound financial instrument? We have done this. Compound financial instrument hai kya ye? Yes, it is a CFI. If it is a CFI, I have to do split accounting. Split accounting के लिए, what is the data that you require? I need you to think and answer. Split accounting के लिए, what is the most important data that you need? What is the most important data that you need? Yes, that's right. And it is convertible at the option. मतलब वो option exercise नहीं करेगा. He can ask for the money also. The principal also. Interest as well as the principal. So now you tell me what is the most important information you need for a CFI? Non-convertible data. Present value of liability component. Basically, you need the interest rate of a similar instrument which is non-convertible. And वो data दिया नहीं है यहाँ पे. That data is not given here. Okay. So that data is not given. So what institute has done, and it is correct in doing that because that data is not there in the first place. Okay. That data is not there. The effective the rate of interest, the fair value of liability ढूंढने के लिए जो market rate of interest I need, that market rate is not given in the question. And therefore, the institute has adopted an approach which is correct in the absence of data. In the absence of data, it is correct. But if such data is given, what we are looking at, the data related to non-convertible instruments rate of interest, if that data is given, we cannot follow the approach we are now going to follow. Is it okay? Yes. So in absence of the data relating to a non-convertible debenture, in absence of data relating to a non-convertible debenture, what the institute has said is it becomes difficult to segregate between a liability and an equity component. And therefore, it is implicitly assumed by the institute that the instrument is entirely a financial liability. Don't jump on me. Don't say that ये ऐसे कैसे हो सकता है, ऐसा नहीं होना चाहिए, वो equity भी मांग सकता है. All your doubts, I place it with due respect. But data is not there in the question. And if data is not there in the question, institute has adopted a very conservative approach, which is correct. Which is correct. Okay. And therefore, since it has adopted a conservative approach, what you could be doing is treat it as a liability. Okay. Original terms. Original terms क्या थे? Original terms, you would get 1000 divided by 50 rupees per share. That means you were getting 20 shares. You were getting 20 shares. Revised terms के under the revised terms, you are getting 1000 divided by 40. That is 25 shares. That is 25 shares. Okay. So therefore, what is the additional inducement you are offering? 5 shares. And what is the price of these shares? The market price of excess ordinary shares on the date the terms are amended is 80. At the rate of rupees 80 per share, you are paying him something extra, no? First you had to give only 20. Now you have to give 25. And because you have to give 25, 5 into 80, rupees 400 is the extra payment which you are making, which is a loss due to settlement. A loss due to settlement. And if it is a loss due to settlement, given that the instrument is a liability, I will be taking it to the P&L. That is what the question has asked. How will the revised terms be accounted? Basically, you are having a loss on settlement, and that loss on settlement, we will be taking it to the P&L. We will be taking it to the P&L. Acha. You have studied financial liability definition. वहां पे क्या था? Fixed for fixed, variable conversion. Fixed for fixed होता, it would be equity. Variable conversion होता, it would be a financial liability. ये वो नहीं है. Because the terms have been modified. The terms are amended. The terms are changed. The terms have been modified. The original instrument gave you a conversion price of 50 for 1000 rupee debenture. That means the conversion was fixed for fixed. And now they are modifying it. They are modifying it. And because it is modifying, you are getting a different number. If the terms were not modified, आपको कितने शेयर मिलते थे? You were getting 20. And because you were getting 20, वो fixed है. For 1,000 rupee debenture, you are getting conversion price 50. So 20 shares fixed for fixed. It was without any doubt, it is an equity component. So I knew that somebody would talk about this, that if fixed for fixed is not met. ऐसी बात नहीं है. Fixed for fixed should not be met without amending the terms. Here you are amending the terms. To induce conversion, आप instrument को ही बदल रहे हो. And when you are changing the instrument, yeah, obviously it will amount to a variability. But when we talk about the fixed for fixed test and the variable test under the definition of financial asset or a financial liability, it is the original terms that do not fix the number of shares. यहाँ पे वो बात नहीं है. Here it is fixed. Face value fixed रहता है. Conversion price is fixed. So number of shares is fixed. You change the terms. That is why the number of shares changed. That is wrong. I mean, not wrong. That is why it cannot be classified as a financial liability. But हमारे पास कोई और option नहीं है. We don't have any other option because it is going to be regarded as a liability because we don't have the non-convertible data. We don't have the non-convertible data. Okay. And therefore, we have to take it to the P&L. We have to take it to the P&L. Okay. Ideally, it should be a compound financial instrument. There would be an equity component. And since we are changing the equity nature of the instrument, this would be taken to the retained earnings and not the profit and loss account. Agar convertible, non-convertible instrument data, if that was given, I would find out the equity component, and if this modification would be introduced, we would take the impact of that modification, 400 in this case, to retained earnings. Yahan pe the non-convertible data is not given, so we are constrained to take it as a liability. We are constrained to take it as a liability. Are we clear? Thoda ajeeb question hai. I agree, it is kind of very different compared to what we have done, what we are going to do, and what you have been exposed to. But kya kare? It has come in an RTP, so I thought it's better that we discuss this unique question once so that you will be comfortable. Okay. Is it okay, everyone? Yes. Is it okay? All right. So that covers this question. Okay. We've done quite a number of questions. How? Okay. This is given in May 2022 RTP. Question number 6. Question number 6. Okay. You can have a look. Okay. How, what you can say, how is your energy level right now? Your brains, are they functioning at optimum capacity or are they functioning very tired? And because I'm thinking of starting the derivative portion which that is left over. Okay. Yes. So how are we placed? Can we continue or do you want to stop for the day? We have done quite a number of questions. Okay. All right. Fine. Okay. It is a little taxing. I agree. Okay. So what we will do is we take a break. I mean, we end the session. Okay. Whatever I had to discuss about financial instrument definitions, whatever I had to discuss about financial instruments, what you say, classification, accounting, off market transaction, convertibles, derivative accounting, what I have discussed last. All these are fully complete from my side with questions. Okay. So what I want you to do, is you have a week, go through these concepts, understand them, do the questions. You should be able to get the concept. Okay. You should be able to get the concept. ओके हिंदी यूज कर सकता हूं बट द थिंग इज क्या है वी हैव वाइड ऑडियंस हालांकि इतना वाइड नहीं रहता है हार्डली देर आर 7 to 8 स्टूडेंट्स हु कीप वाचिंग बट स्टिल इट्स फॉर द बेनिफिट ऑफ एवरीवन सो व्हेन आई यूज हिंदी मैं इमीडिएटली उसको इंग्लिश में बोलना जरूरी है बिकॉज आई डोंट वांट others to get to lose out on any concept. Okay, तो ठीक है तो go through all these. We have covered effectively about 85 to 90% of your chapter. Okay. What is left is embedded derivative splitting, derecognition of financial assets and liabilities, not very important, expected credit loss model, and some small things here and there, which I can honestly drop it off for homework also. It's not at all complicated. It's very simple. Okay. So these 3-4 topics are there and hedge accounting. Okay. Hedge accounting. So these many things are there. We'll try to cover all of them in the next class. Okay. All right. So that's it for today. And आज के लिए तो definitely rest ले लो. Please take rest today. Okay. All right. Don't we have exam question of financial instrument separately somewhere? हर एग्जाम में आता है. What are you talking? Which question? Every exam it has come. अभी today's question what we did, question 6B, that was an examination question only. Yes. May 22 exam question. वो exam question ही था. This one. जो क्वार्टरली ये वाला क्वेश्चन क्वार्टरली जो है वो एग्जाम क्वेश्चन ही था यस सो है ना यू हैव क्वेश्चंस रिलेटिंग टू एग्जामिनेशंस आल्सो बट इट्स लार्जली कमिंग फ्रॉम व्हाट वी हैव डन ओके ये जो एक दो थोड़े अजीब टाइप के क्वेश्चंस थे विच आर स्लाइटली टिपिकल यू नो द एडजस्टमेंट्स विल बी एबल टू सॉल्व आपको एडजस्टमेंट्स कभी देखे ही नहीं हो देन यू विल बी what you can say you will be at a loss in the exam. Okay, so that is the reason I did that. Okay, now can't we get all financial instrument questions of all exams at one place? Okay, I will compile and share it with you over the week. Okay, I have also uploaded my notes that we were discussing in the sessions. Okay, so I hope that you could download them. What I'm going to do is she has asked for the financial instrument questions of all exams in one place. Okay, I'll give that. Okay, I'll compile it and share it with you. So you should be able to practice. Okay, what I will also do is I will also map it with the study material question that it resembles. Okay, so then you do that question, you will say that exam mein ye ho gaya hai. Okay, so that or if the questions are similar, I'll just prepare a table saying that this is the question and corresponding exam mein ye wala question aaya tha. Okay, so that should take care of the examination scenario for you. Okay, all right then. So take care everyone, revise and come. Next class, I'm not going to revise what I have discussed. I'll be straight away starting with derivative accounting. Okay, so as of now, what I have covered today will not be revised in the next session. Any doubts you have, you know where to reach on the mail ID of the institute, fr-final@ici.in. Please feel free to reach out if there is any pressing doubt. Okay. All right then. Thank you everyone. Take care and thank you for a patient hearing. Okay. Thank you. हाँ जी. Yes. Thank you.